am loud and clear. So,
Yes, we can hear, sir. Yes, we can hear.
yes, great. So, first of all, let me thank CS Sri Lanka for organizing this session for the benefit of the students community who are participating or facing for the examination, CL2 examination in this December 2023 session. So, today what we are going to discuss is actually June 2023 paper, right? CL2 paper, June 2023. So the session would be conducted today as well as next week, because we might not be able to complete the entire thing today. So that it would be conducted today as well as same time next week as well, right? Because I want to discuss the paper, just not to complete the paper, but also to discuss the relevant related areas, what is important for the upcoming examination as well, right? Okay, so what we're going to do is we'll be starting with section 1. So, section 1 consists of 10 objective test questions, right? So we'll be starting with section 1. So what I did was actually I have prepared a PowerPoint presentation as well for this session, so which I have already shared with CS Sri Lanka. So if you didn't get it, maybe at the end of the presentation, CS Sri Lanka will make necessary arrangements to share the presentation with you, right? Okay, so let's start then. Without further ado, let's start. So the first question, 1.1. Now let me go to the PowerPoint presentation because I have incorporated, right? I have incorporated these questions into the PowerPoint presentation itself for the easy reference. So let's discuss the paper from there. So the objective test question. So the first question, what it says is, which of the following statements correctly describe the conditions to be satisfied for a company to make a distribution? For an example, to make a what? Dividend payment. So the distribution means main type of distribution that we know is dividend payment by the company, distribution to the shareholders, purely according to the Companies Act number 7 of 2007. According to the Companies Act, right? So what are the conditions to be satisfied before making a distribution to the shareholders, or else before making a dividend payment to the shareholders? So, section 1 of the paper can be tested from any area of the syllabus, right? So the examiner has the liberty to test these questions from any area of the syllabus. But let me ask you, what is the area in which this particular question is tested in your syllabus? So it is tested from regulatory framework. So there you have, Companies Act. Then there are different types of act, Accounting and Auditing Standards Act, right? So CSC, Colombo Stock Exchange listing rules, then the SEC regulations, industry-specific things like Banking Act. All these things are coming under the regulatory framework. So this particular question is more specifically from where? From the Companies Act. If you look at the section of the Companies Act, that is actually section 56 of the Companies Act. What it says. So that's why I said that I would spend a bit more time rather than just answering to the question, for you to give a background of the particular question and to elaborately discuss the answer, which is the purpose which I presented or prepare this PowerPoint presentation. So when it comes to a distribution, first thing is it has to be authorized by the board of directors of the company. So the board, now if you look at a dividend payment, board has to first propose. That means board has to authorize that particular dividend payment. Board authorization is not enough. What you need to do is, if it is a distribution or if it is a dividend payment, it has to be subsequently approved by the shareholders. So that's why normally in an AGM, right, annual general meeting, you get the approval of the shareholders through an ordinary resolution to distribute dividends. So the board authorization is the first step, and thereafter approval of the shareholders. After that, after getting the approval of the shareholders, when you make the dividend payment or when you make the distribution, immediately after the distribution, directors are responsible to ensure that company satisfies the solvency test, because you can't make distributions making your company insolvent. What do you mean by solvency test in simple language. Solvency test means after making distribution, because making a distribution means your cash, most of the time your cash will go out. So when you make the distribution, after you making the distribution, right? So company should be able to pay their debt in the normal course of business. So the solvency test satisfaction means company should be able to pay their debt in the normal course of business, as well as your company's assets are more than the share capital and the liabilities. So which means, in other words, company should have a positive retained earnings. After the distribution, company should have a positive retained earnings. So upon satisfaction of these three conditions, which means board authorization, approval by the shareholders, and after the distribution, immediately after the distribution, company should satisfy the solvency test. So these are the prerequisites to make a distribution, which means what is the answer? Answer is answer. So if you look at the four answers, so answer is what? B. So which means board approval, shareholder approval, and passing of the solvency test. So that is the first question under the section 1 objective test question. Right. I hope you understood about it. Right. Moving on. So as I mentioned, so this PowerPoint presentation, if you didn't get it up until yet, don't worry. So I have already shared this with CS Sri Lanka. They will definitely share with you. So you, even if you don't get it, make a request from the coordinators of CS Sri Lanka. They will definitely share the presentation with you. Don't worry. Right. Moving on. Second question. In order for Sri Lanka accounting standards to become legally authoritative, they should be. Now, you know, CS Sri Lanka is the responsible body to issue the accounting standards in Sri Lanka, right? So we have LKASS and the SLFRSS. So now these standards to become legally authoritative, what should be the condition to be satisfied? What is the correct answer to fill the above blank? So answer A is translated into Sinhala. So is it the point where it becomes legally binding, legally authoritative, approved by the Council of CS Sri Lanka, published in the Extraordinary Gazette, issued by the International Accounting Standard Board? So what is the point at which it would become legally authoritative? So yet again, discussing the background of the question, okay, the question is tested yet again from the area of regulatory framework, right? Regulatory framework. So now this is the process of adoption of IFRS as SLFRS. So the International Accounting Standard Board adopts IFRS. So what CS Sri Lanka does is, so then CS Sri Lanka review that and convert the particular IFRS, so the same IFRS, sometimes with minor modifications, so published as SLFRS. Okay, so that is the process. So, but to answer to this question, you should know the correct process, how the process is exactly happening, and what is the point at which it would become legally binding, legally authoritative, right? So what happens is, as I mentioned, once IASB, that is the International Accounting Standard Board, once they issue or finalize an IFRS standard or a IFRIC interpretation, right? It can be a standard, it can be an interpretation. What CS Sri Lanka does? CS Sri Lanka, without making or publishing as a SLFRS, what they do is they make a review. CS Sri Lanka make a review of this IFRS standard and the whatever the technical materials issued by IASB, right? So when CS Sri Lanka do this review or carries out this review, CS Sri Lanka might decide, okay, as it is, we'll publish the SLFRS and we'll use the same effective date as in the case of IFRS. So that can be decided. Or else CS Sri Lanka might decide, okay, let's do a few minor modifications be in line with our context, our country, or else sometimes CS Sri Lanka might decide to postpone the effective date. So let's say if IASB decides to make the effective date today, but CS Sri Lanka might decide, okay, our people need some time to learn about this, so we'll make it effective in a couple of years, right? So, or else CS Sri Lanka might decide, no, this is fine, we are okay with that, go ahead with the same version as well as same effective date as per IASB. So for that, what CS Sri Lanka does is CS Sri Lanka carries out a review. Then after making the decision, so after carrying out this particular review, so CS Sri Lanka decides, okay, what would be the standard and what would be the effective date. Then it is the particular standard is getting translated into Sinhala and Tamil versions, right? But still it is not yet authoritative. Our question is, what is the point it would become authoritative, right? So it is getting translated into Sinhala and Tamil, and thereafter, this is the point, thereafter it is published in extraordinary gazette. It is published in extraordinary gazette, which is requested by another act passed in the parliament. What is that? Accounting and Auditing Standards Act number 15 of 1995. This act requires particular standard to be legally authoritative. It has to be published in the extraordinary gazette, right? So once gazetted only, the standard becomes legally authoritative. So which means, what is the answer to the question? What is the point at which it would become legally binding? So once it is published in the extraordinary gazette. So you should understand the entire process, because this time it was tested about the point where it would become legally authoritative. But you should know the entire process of adopting an IFRS or a IFRIC interpretation into a legally binding accounting standard in Sri Lanka. Okay, so always remember, so the examiner is testing questions, especially these objective test questions from the regulatory framework. So you should be thorough with that. It's theory, but you should be thorough with that, because always there are questions in the examination, right? So we have answered for the second objective test question as well. Moving to the third one, right? Moving to the third one. Which of the following Global Reporting Initiative standard provide guidance for the reporters in the GRI standard? So can anybody tell me what is the area in which this question is tested? What is the area where the question is tested? It's tested from the non-financial reporting. More specifically, this is about the sustainability reporting. So with regard to sustainability reporting, we know when it comes to reporting, you look at the economic aspect, you look at the environmental aspects, you look at the social aspects. And the most prominent framework which is developed for the sustainability reporting is the Global Reporting Initiative, or the GRI standards, GRI framework, right? So the question is, now with regard to the GRI standards, there are a number of GRI standards. So the question is, which of the following GRI standards provide guidance for the reporters in the use of GRI standards? So whether it is universal standards, economic standards, environmental standards, or the social standards. So yet again, so this is the answer. So if you know this part, this is actually directly taken from your what you call study pack, right? So what is applicable for your examination? So at the moment, there are 36 GRI standards which are issued by this particular body. And these 36 standards are split into 4 groups. So these 4 groups are the 4 answers in the question, right? So basically, answer to the question is actually the universal standard, because universal standards actually guide reporters, that means entities, how to use this GRI standard. It provides guidance to the reporters on how to use this GRI standard. In addition to that, universal standards talk about the contextual information about the organization and how the material topics are manage, how the entity has to manage about the material topics, right? So then the economic standards talks about how the material aspects with regard to the economic topics are dealt with. For an example, entities performance, entities procurement policies, right? So the economic aspects. Then the environmental standards talks about things like, energy, renewable and non-renewable energy. Then environmental protection laws, right? And green products, how to ensure that the environmental friendliness is maintained while you are carrying out your business activity. Then the social status talks about, employment relationships, right? Community development aspects. So whether you are using child labor for the production. So the social issues are discussed by the social standards. So basically economic standards, economics aspects like performance, environmental standards, environmental aspects like, adhering to the environmental regulations and all. Social aspects, things like community development work, labor relations, those sort of stuff. So the universal standards are the standards which guide reporters on how to use the GRI standard. So answer to our question is actually what? Answer A, right? Okay. So because non-financial reporting is an important topic in the examination. So this is about the sustainability reporting. This time in the examination, examiner might test about the integrated reporting, right? Other prominent area in terms of the non-financial reporting would be integrated reporting. So in this paper, so in the previous paper, that is June 2023, it was about sustainability reporting. This time it may be about what you call integrated reporting. So you should know the integrated reporting framework issued by IIRC, International Integrated Reporting Council, right? Okay. Moving on. So if you have any questions, doubts, you can use the chat box to ask questions, right? Right, let me move to the fourth question of section 1. So what it says, Sama Private Limited, SPL, purchased 5 barcode readers on 1st July 2022 to be used with its point of sale machines, right? So these barcode readers were purchased to be used with the POS, point of sale machines. Point of sales machines were purchased on 1st December 2022. Subsequently, only you actually acquire the barcode readers first to be used with these POS machines, but at the time of purchasing the barcode readers, POS machines are not there. So those POS machines were purchased on 1st December 2022. That means there's no use of these barcode readers, even they were purchased, right? Because the machines were not available, POS machines were not available. And it was, so the POS machines were purchased on 1st December 2022. Then installation of POS machines were completed by 31st March 2023. Okay, after you purchase the POS machines, so you have completed the installation of POS machines only by 31st March 2023. Yet again, up until you purchase and install POS machines, there's no use of these barcode readers, right? Then the supermarket opened for customers. So the supermarket opened for the customers only on 1st May 2023. Now these POS machines, why these POS machines, point of sale machines were purchased? Because to use in the supermarket. But the supermarket opened for the customers. So start carrying out the business operations, business activities only on 1st May 2023. Now, what you need to understand is both POS machines and the barcode readers, there's no use up until you start the supermarkets. You can't use them, right, for the activity which is intended by the management. So the question is, SPL should start depreciation of the barcode reader. So where you should start the depreciation process of the barcode readers? Is it on the date where the barcode reader is purchased? That is on 1st July 2022. Or else, is it the date on which POS machine was purchased? 1st December 2022. Or is it at the point where POS machines were installed, which is on 31st March 2023. Or else, is it the date on which the particular supermarket start its business, or basically start its operations, start sales to the customers. So what is the point at which you start your depreciation process of the barcode readers? What do you say? What is the point? So you should understand. So the very simple standard, all of you are aware about it. LK 16, property, plant and equipment standard. This is the area in which the question is tested. So yeah, you should know when you should start depreciation. Read this statement. Again, this is from the standard from LKS 16. So it says that depreciation commences when the asset is in location and condition. It should be in the correct condition and it should be in the correct location, necessary for it to be used in the manner intended by the management. So what should be the correct location where the asset is to be there to be used in the manner intended by the management in the supermarket, right? Without the supermarket having the barcode readers as well as POS machine, there's no use, right? It is in the condition of usage, but it's not in the correct location. So both conditions, location and condition necessary for the intended use in the manner intended by the management is satisfied only after supermarket starts their operations, which is on 1st May 2023. So which means the answer to the question is what? Answer D, right? Okay. I hope you understood about it. Clear? Moving on. Moving to question number 5 of the section 1. What it says. What it says is Prashansa Private Limited has an investment in equity instrument which is classified as value through OCI, right? So what is the classification? It's the equity investment, equity financial asset. You invest in shares of some other company, right? So when you invest in a shares of some other company, you have two types of classifications, right? Either you can put that under fair value through profit and loss category, or else if two conditions are satisfied, you can put that under the fair value through other comprehensive income category. So what are two conditions? Number one, instrument should not be held for trading purpose. Second condition to be satisfied is you have to do this designation as fair value through OCI at the initial recognition. That means on day one, and once you designate that, it's an irrevocable choice. You can't reverse your decision. So upon satisfaction of these two conditions, you can put the investment under fair value through other comprehensive income. Now it's clearly mentioned this company classified this investment under fair value through other comprehensive income. When you classify an investment under fair value through other comprehensive income, what do you do? You know, initial measurement of the financial assets or the financial instruments are at fair value, right? Then subsequently, what you do is each reporting date, right? Each reporting date, you fair value this particular investment. You fair value the particular investment. Fair value changes are taken to the other comprehensive income. If the fair value increases, you debit the investment that increase and credit entry goes to the other comprehensive income. Then this amount, what is recognized in the other comprehensive income, you accumulate in an equity account called investment reserve. You have a separate equity account called investment reserve. Some people used to call this as fair value through other comprehensive income reserve. So in that equity reserve, the total amount is getting accumulated, right? So that's the accounting treatment. Now you have been given the following information about the investment in the equity instrument. Fair value asset. Fair value asset 31st December 2022, 150 million. Fair value asset 31st December 2021, 130 million. initial carrying value at the purchase date. What is the purchase date? Initial acquisition date. Initial recognition has happened on 1st January 2021. At that date, it was at a value of 100 million rupees. So then over the period, you see, in the first year, it has gone up to 130. Thereafter, at the second year, it has gone up to 150. So this is what is happened. This is what it has happened. Okay. So the mentioned accounting treatment would be at each reporting date, you should fair value the investment, and the fair value gains and the losses are taken to the other comprehensive income, right? Which means in the first year, you should have taken 30 million rupees into the other comprehensive income, right? So if you have taken 30 million rupees to the other comprehensive income and take the same amount into the value of the investment, right? So then at the end of the first year, if I look at equity reserve in the balance sheet, this is the equity reserve on the balance sheet. Now the first year amount recognized in the other comprehensive income is 30 million. So the equity reserve value should also be 30 million because it's the first year. Then the second year, there's a further increase from 130 to 150, which means it's an increase of 20 million in the other comprehensive income. Then what is the total value in the equity reserve? 30 is already there, plus 20, it has to be 50 million. Okay, so the initial purchase price on 1st January 2021, 100 million. At the end of the first year, it has gone up to 130. Second year, it has gone up to 150. So the OCI amount in the first year, 30 million. Second year, 20 million. On the other hand, equity reserve value, the cumulative value, 31st December 2021, it has to be 30 million. 31st December 2022, it has to be 50 million. I hope all of you understood about this, right? Then gain or loss on disposal of this investment will be taxed at the statutory tax rate of 30%. So once you sell this investment, once you realize this investment, so at the moment, these gains and the losses are unrealized. It is not yet sold. So up until you sell it, you don't need to pay taxes to the government. But when you realize this gain, which means at the point where you actually sell this investment, you have to pay the tax at 30%. Okay, when you are paying taxes, remember, inland revenue people, they don't understand these fair value concepts and all that, right? For them, what is the gain on which you have to pay taxes? Same price minus this initial cost where you acquire this investment. You acquire that at 100, whatever the price that you sell, right? Let's say if you are selling that at 31st December 2022, let's assume if you are selling that at 150 million at fair value, then what you should do is 150 million minus 100, which is how much? 50 million profit. On that, you have to pay 30% taxes. 50 million into 30% would come into about 15 million taxes are to be paid at the time of realization, right? But at this moment, it has not yet been disposed. Which of the following correctly describe the accounting treatment for the deferred tax? Now, examiner is asking you deferred tax implication of this particular accounting treatment for the, very important, understand the question, for the year ended 31st December 2022. He is asking the impact to the particular year. That means in this particular example, impact in the second year, not the total impact, right? He's asking the impact for the second year, right? 31st December 2022, right? So who can tell me the answer? Any guesses? Can you say that, okay, this is the answer? Any guesses about the answer? What would be the correct answer is? Any guesses? Okay, right. Let's see. Right. So the area that is testing this question is, one is obviously the financial instrument knowledge. The other one is more specifically, the question focuses on LKS 12 income taxes. Income taxes, we know there are two types of income taxes. Current tax, that is the actual tax that you need to pay to the government. based on your taxable profit, and the other one is accountant's adjustment of tax, that is the deferred tax, right? So this particular question is tested actually from the area of deferred tax. Now, in the case of deferred tax, what in summary, right? It's a very lengthy topic. I don't have time to discuss the entire logic behind the deferred tax concept, but I have given you a hint earlier, right? I told you in case if you dispose this asset as at 31st December 2022, there will be a taxable profit of 50 million, that is 150 minus 100. You have to pay a tax on that profit at 30%. But as it has not yet been disposed, you don't need to pay taxes actually at the moment. But in future, there can be a tax payment. In future, there can be a outflow in terms of the taxes. Now, what accountant has to do is accountant has to recognize the tax effect of that particular transaction that's going to happen in the future in the financial statements now. That is the whole concept behind the deferred tax topic, right? So to compute the deferred taxes, what you do is you have to find out what is the temporary difference is. So temporary difference is calculated by taking the difference between the SLFRS carrying value, that is the book value, and the tax base, right? Then you have to decide whether that particular temporary difference is a taxable temporary difference or a deductible temporary difference. Taxable temporary difference will lead to deferred tax liabilities, and deductible temporary differences will lead to deferred tax assets, right? So you take the particular temporary difference, you multiply it by the tax rate to get the deferred tax value. Actual amount of the deferred tax is taken, take the particular temporary difference, multiply it by the tax rate. In this question, tax rate is given as 30%, right? Then the next question is, let's assume when you have a deferred tax liability, you should decide whether I'm going to recognize the deferred tax asset or the liability, other entry of the deferred tax asset or the liability in the profit or loss, or else in the other comprehensive income, through that whether it goes to the equity. So normally, most of the times, impact of the deferred tax is recognized in the P&L most of the time. But if the particular transaction that amounts to the temporary difference, listen carefully, most of the times, impact of the deferred tax is recognized in the profit and loss statement. But if the deferred tax arise because of a particular transaction, and that impact of the transaction is recognized in OCI, then the relevant deferred tax impact is recognized in the OCI. This is a clear example for that. Now, in this case, you have a deferred tax adjustment. Why? There's a difference in the carrying value and the tax base. There's a difference in the carrying value and the tax base. And that difference you taken to the other comprehensive income, because fair value changes are taken to the other comprehensive income, because tax base is always the cost of the investment. Now, in this particular question, taxman doesn't understand these fair valuations. He doesn't know fair valuations. He don't like these valuations and all that. For him, tax base is always what? Cost of this investment, 100 million. But the carrying value is getting changed at the end of each year, because you are fair valuing this investment in your financial statements. 31st December 2021, it has gone up to 130. 31st December 2022, it has gone up to 150. So the carrying value is getting changed, right? So there's a temporary difference. That particular temporary difference is recognized in the other comprehensive income. So as the temporary difference is recognized in other comprehensive income, relevant deferred tax impact also to be recognized in the other comprehensive income. That is the first conclusion. Okay. Then how do we calculate what is the impact? So the question wants us to understand and calculate the impact of this particular deferred tax adjustment for the year ended 31st December 2022. Right? For the year ended 31st December 2022, what is the impact? So what do we do? So let's do a simple computation here. I'll take the I'll take a new slide. Second, we take a new slide. right? So there, if you take it like this, now for example, let's say, what's it called this? Right. So let me take it like this. I'll prepare a small table. Carrying value, carrying value, and the tax base. Now tell me first initial acquisition date, 1st January. If you look at 1st January, what is the date on which this investment was acquired? 1st January 2021. Right, 1st January 2021. Carrying value is how much? 100. So the question I'm working out in is in millions. Tax base is also 100 because on the initial recognized date, there's no difference between the carrying value and the tax. Okay. So then 31st December 2021, at the end of the first year, carrying value gone up to 130. Okay, because the value has gone up to 130. Tax base is still 100. Now there's a temporary, sorry, sorry, you couldn't see what I was writing, no? 1 second. Okay, now can you see the screen now, please? Okay, right, sorry for that. Okay, so what I was telling is I have prepared a table. What I did was, so first of all, I have taken the carrying value. Thereafter, the tax base value. 1st January 2021, that is the date of acquisition of this particular investment, right? Carrying value was how much? 100. The price that we purchased, that is the value at which you record the asset in the books. Tax base is also 100, right? There's no change. Then at the end of the first year, 31st December 2021, you have fair value investment. So which means carrying value has gone up to 130 because you are fair value in the investment. You are fair value in the investment. But the tax base is still 100. Because tax base for the taxman, it is always at cost. Now this creates a temporary difference. What type of a temporary difference? Is it a taxable temporary difference or deductible temporary difference? We learned that with regard to an asset, if the carrying value is higher than the tax base, in this case, carrying value 130, tax base is 100. If the carrying value is higher than the tax base, that is a taxable temporary difference. Okay, so how much is the taxable temporary difference as at 31st December 2021? 30. Right? What do you mean by taxable temporary differences? You have to pay more taxes in the future. Why do you need to pay more taxes in the future? Because now, if you sell this investment at 130, as at 31st December 2021, there will be a tax profit of how much? 30. There will be a tax profit of 30. And this 30 into 30%, tax rate is 30%, 30 into 30%, I have to pay as taxes to the government. But yet the investment is not yet sold. So because of that, I'm not going to pay taxes at the moment. But there will be a future implication of making the tax payments. For that, what I do is I recognize the deferred tax liabilities. So it's a taxable temporary difference because I have to pay more taxes in the future. So how do I calculate the taxable temporary difference? I'm getting the difference between the carrying value of the asset 130 and the tax base of the asset, which is 100. So the technical or the theoretical way of deciding whether a particular temporary difference arise a deferred tax asset or a deferred tax liability, or whether it is a taxable temporary difference or a deductible temporary difference, is look at the carrying value of the asset and the tax base of the asset. If the carrying value of the asset is higher than the tax base, that is a taxable temporary difference of 30. Then how do you calculate the deferred tax liability? You multiply this 30 by 30%. So which means deferred tax liability value would become how much? 9, which is as at 31st December 2021. So what is the double entry that you need to pass? As at 31st December 2021, deferred tax liability of 9. You debit this to the other comprehensive income, debit 9. Credit entry goes to the deferred tax liability account. Is that clear? Because at the beginning of the year, there was no deferred tax liability. At the end of the year, which means 31st December 2021, you have a deferred tax liability of 9. So you credit that to the deferred tax liability account, and the difference you take to the other comprehensive income, because transaction, so the fair value gains and the losses have been recognized in the other comprehensive income. But this is not the question tested in the exam, because the question tested in the examination was what is the impact for the year ended 31st December 2022. That means for the second year. Then do this calculation for the second year as well. Now you can tell me what to do. 31st December 2022. What has happened to the carrying value? Carrying value has further gone up, because carrying value is equal to the fair value. You are fair value in the investment, which is 150. But the tax base won't change. It is 100. Which means it gives us a taxable temporary difference, which means carrying value of the asset is higher than the tax base by 50. Right? Because if you dispose the investment today at 150, you have to pay tax. So the tax profit would be then 150 minus 150, that into 30%, you have to pay taxes to the government. But as it is not yet disposed, you are not going to pay taxes, but you have to recognize that impact in the financial statement in way of deferred tax adjustments. That is the logic of the deferred tax adjustment. So you have calculated taxable temporary difference is 50. Then how to calculate the deferred tax liability? This into tax rate 30%. You get the deferred tax liability. 50 into 30%, how much? 50. Right. Now tell me, what is the entry that you are going to pass in the second year? Remember, at the end of the first year, that is 31st December 2021, you already have a deferred tax liability in the balance sheet. This deferred tax liability is recognized in the balance sheet or the statement of financial position. This is in the statement of financial position. 31st December 2021, you have a deferred tax liability value of 9. As at 31st December 2022, the deferred tax liability value has to go up to 15. What you need to do? You recognize or you increase the deferred tax liability value by how much? 6. 9 to 15. How do you increase? By passing an entry, right? In accounting, increase or decrease of an asset or liability or whatever is done through double entry. So what is the double entry? Yet again, you debit OCI how much? 6, and credit the deferred tax liability 6. So the deferred tax liability value will increase from 9 to 15 by 6. That increase you recognized in the other comprehensive income. Then this amount, what is recognized in the other comprehensive income, is getting accumulated in the equity reserve. First year you recognized 9, second year you recognized 6. So the total amount is accumulated in an equity reserve on the balance sheet. On the other hand, balance sheet deferred tax liability value is 50. But the question wants us to explain, or to the answer, what is expected is not the balance sheet liability for the year ended 31st December 2022, for the year ended 31st December 2022. What is the impact to the financial statements? Which means, what is the impact to the financial statement for the year ended 31st December 2022 is you recognize what? 6 billion of deferred tax expenditure through other comprehensive income. Okay, so for the year end 31st December 2022, you recognize what? additional amount of deferred tax expenditure of 6 million to other comprehensive income, which makes our total deferred tax liability on the balance sheet as at 31st December 2022 to 50. So these are good questions for you to understand the concept of deferred tax. But as I said, it's a very technical session. It takes a lot of time to explain the logic as well as the rule, because the logic I have explained you, right, by giving an example. If this is sold at 150 million at 31st December 2022, what's going to happen? You have to pay taxes. So that is the logic. So as it's not yet been sold, you don't need to pay. But once it is sold in the future, you have to pay. So that tax impact you have recognized in the financial statements now. So that's the logic behind recognizing of the deferred tax liabilities on the balance sheet. So then the rule is, this is the rule. So always when you are calculating the deferred tax asset or a liability, take the temporary difference, which is the difference between the carrying value of the asset and the tax base. Then if it is a taxable temporary difference, which you need to pay more taxes in the future, that will amount into deferred tax liabilities. On the other hand, if the temporary difference is a deductible temporary difference, which will lead to pay less taxes in the future, that is amounting to a deferred tax asset. So how to calculate the deferred tax liability or the deferred tax asset is, you take the temporary difference and multiply it by the applicable tax rate, which is 30% in this question. Then I already explained to you, normally the deferred tax impact is recognized through the P&L, but if the particular transaction amounting to the deferred tax adjustment affects the other comprehensive income, relevant deferred tax impact is also recognized through other comprehensive income. Right, that's a summary of the entire deferred tax topic. So important area. If you are, not comfortable or clear about the things what I explain, what you do is go back and refer your notes, as well as you can watch the videos and understand that in detail. Okay, right. So let me move on. Hope that is understood. I took little time to explain because deferred tax is something some students are not clear about. Okay, what it is and how to calculate it. Right, let me move on. Move into the question number 6. What is question number 6? Leather Lanka PLC assessed a contract to import 1,000 units of handbags as an onerous contract. 1,000 units of handbag as an onerous contract. What do you mean by onerous contract? Okay, due to the unexpected rupee depreciation that has happened in April 2022. Okay, in April 2022, there was a unexpected rupee depreciation against the foreign currencies. So because of that, this particular company is having an onerous contract. So now, what do you mean by onerous contract, by the way? Your unavoidable cost of fulfilling the contract. Unavoidable cost of fulfilling the contract is higher than the economic benefits that you're going to realize out of that contract. Okay, so you know for sure that you're going to make a loss out of this contract. Then it's a onerous contract. And you can't cancel the contract either. Right? If you can cancel the contract without paying a penalty, if you can avoid the loss, then it's not an onerous contract, right? So the onerous contract means a contract where even though you know that you're going to make a loss, you have to continue with that. Because this particular contract on 1,000 units to import is a contract which you can't cancel. You have entered into the contract. You have to obey with the contract. So it's a onerous contract. So additional details are given. In this particular contract, what is the expected benefit? 200,000. But cost of fulfilling the contract is 550,000. This is what I mentioned. To fulfill the contract, you have to incur 550,000. By knowing that your expected benefits are only 200,000. That means what is the net cost of continuing the contract? 550 is the cost, 200 is the benefit. So your net cost of continuing the contract is 350,000. On the other hand, if you want to cancel the contract, you have to pay a penalty of 600,000, right? Now, rather than paying the penalty, it's worthwhile to continue, right? Because if you pay and cancel the contract, you have to pay 600,000 as penalties. But if you continue the contract, your net cost of continuing the contract is 350,000. What is the amount recognized as provision for this onerous contract as per LKS 37? Provisions, contingent liabilities, and the contingent assets standard. Right, tell me, when you, now this particular area of this question is LKS 37, provision, contingent liabilities, and contingent assets. So under this standard, there are different types of provisions discussed, right? Things like, warranty provision, restructuring provision, environmental provision, right? So this is one area, onerous contract. So I explained to you the onerous contract. Unavoidable costs are higher than the economic benefits, right? When you have an onerous contract in this nature, you have recognized the present obligation. At the moment, you have obligation. Under the onerous contract, you have recognized that as a liability. How do you measure the value of the provision? You compare two things and take the low value out of these two. Measure the provision of the onerous contract at lower of cost of terminating the contract or net cost of continuing the contract. We looked at net cost of continuing the contract, 350,000, right? Okay. Cost to fulfill 550 minus expected benefit 200,000. So the net cost 550 minus 200, 350,000 is the net cost of continuing the contract. Then the cost of terminating the contract is how much? 600,000, because if you terminate, you have to pay a penalty. Then which one is lower? This is lower. So that your present obligation is at 350,000. This has to be recognized as a provision in the financial statements, right? So answering to the question, answer is what? C, 350,000. But remember, if you can cancel the contract without paying a penalty, let's say this is the situation, right? So 200,000 and 550,000 is same, but if you can cancel the contract at any time without paying a penalty, then the particular contract is not onerous, right? Because if that is the case, you will not continue the contract, you will close the contract, you will cancel the contract because you don't need to pay a penalty. But here, that's why I mentioned, if the contract can be terminated without paying a penalty, then it's not onerous. Okay, right. Is that clear? I hope you understood again. Moving on. Question number 7 of the first section of June 2023 paper, CL2 paper. So we are discussing section 1 objective test questions. We discussed 6 questions and this is the question number 7. Right. So you understand why I explained, or is it too fast? I hope you understood. The speed okay? So this particular situation, the provision amount to be recognized is 350,000 in the previous question. You debit that to the P&L 350,000 and credit that to the provision account. Okay, right, clear. Right. Okay, great. You understood. Moving on. ABC Private Limited pays 10% of an individual employee salaries to a fund managed by an external party. 10% of the employee salaries paid to a fund managed by an external party. The fund will invest this deposit in equity investments on behalf of the respective employees. So what this fund does is they collect this money. Right now, ABC company pays 10% of the employee salaries to this fund. So the fund will invest this deposit in equity investment on behalf of the respective employees, right? So this is the ABC company, ABC Private Limited. So what they do, they remit 10% of salaries of the employees to a particular fund, right? What this fund does is, this fund make investments, right? So invest this deposit in equity investment. Fund would make investments. They make various investments. Okay, various investments in equity shares, right? And so on behalf of the employees, because ultimately, so this money belongs to the employees. On behalf of the employees, fund carries out the investments. Employees can withdraw the deposit plus the investment return at the time of the retirement. So what employees can do is, employees can withdraw the investment what this particular fund has made together with the return at the time of the retirement. Very important. Employees can withdraw that only at the time of the retirement. ABC does not have any further obligation. ABC means company. The obligation of the company is what? Just to remit 10% of the employee's salaries to the fund. Thereafter, ABC doesn't have any obligation to the employee, right? So the employees are required to take the risk of the investment made by the fund, because the fund made the investment. Let's say if the return is less or return is more, so that risk is with the employee, not with the company. Our company is ABC, because obligation of the ABC is just to remit 10% of the salaries to the fund. Once it is remitted, ABC is no more responsible for anything that this fund carries out on behalf of the employees. Right? Employees at their retirement, they have to go to the particular fund and ask the investment plus the return. Employees can't ask anything from ABC company at their retirement. Are we clear? Right. So the question is, which of the following best describe the above accounting treatment of ABC? Right. This is something similar to what our ETF, right? EPF and ETF. So what entity's obligation is to remit the percentage of the salaries to the fund managed by the government body. At the retirement, what employees have to do is, they have to go and ask the money from the government authority, EPF board and ETF board. Employees can't ask this money from the company. So the company's obligation is over once the company send the particular percentage to the government fund. So in this case, it's not a government fund, it's a fund managed by an external party. So the ABC, as the company, they send the percentage of the salaries to the fund. Then thereafter, entire activities are rest with the employee and the fund to get their return at the time of the retirement. So which of the following best describe the above accounting treatment of ABC? What do we say? So there are two standards which are given as the answers. One is LKS 19. LKS 19 is the employee benefit standard. SLFRS 2 is the share-based payment standard. Actually, when it comes to these objective quiz questions or objective test questions, you can follow the elimination approach, because you should first of all understand, okay, what is the area in which this particular question is tested? Is it from LKS 19 or is it from SLFRS 2? This is not from SLFRS 2, you know for sure, because SLFRS 2 is what? Share-based payments. Share-based payments means either entity issue equity instrument to the employees, right? So entity can issue share options to their employees, or else entity can make a cash payment to their employees based on the share price of the particular organization. So there's nothing like that, right? Because with regard to the share-based payments, you have equity settled share-based payments and cash settled share-based payments. Equity settled means entity issue a equity instrument. It can be a share, it can be a share option. Cash settled share-based payments mean entity make a payment in cash. It is depending on the share price. There's nothing such that in this question, right? So because of that, we know for sure C and D are out. Eliminate. Then whether it is A or B. We know under the employment benefit standard, there are different types of employment benefits like short-term employment benefits, long-term employment benefits, termination benefits, and post-employment benefits. Out of that, actually, this particular question is from the post-employment benefit. Why? Employees can entitle for this return, employees can withdraw their return only after they retire, not during the employment. So that it's a post-employment benefit. After the employment is over, only they can enjoy this benefit. But our entity means we have to answer the question from the point of view of ABC. ABC's point of view, ABC has recognized the cost over the period where the employee provides the service. Even though employees withdraw this after the retirement, ABC has recognized the entire employment cost, all the employment cost during the period where particular employee work for the organization, right? Work for the company. Now then the question is whether this particular post-employment benefit plan is a defined benefit plan or a defined contribution plan. What is defined in this situation? Is the employee's benefit is defined or whether the contribution is defined? What is defined is the contribution here, which means ABC's responsibility is what? Only to send 10% of the employee's salaries to the fund. Thereafter, ABC doesn't have any obligation. ABC doesn't worry about whether the employees get the money at the retirement, how much of return that they get. That is not a problem of ABC. ABC's concern is to send 10% of the salary at the end of each month. That's it. So what is defined? Contribution, not the benefit. So this is from LKS 19, employee benefits. So these are, as I mentioned, these are post-employment benefit because employee benefit is payable after they complete the employment. So there are two types of post-employment benefits: defined contribution plans and the defined benefit plans. So why do I say that this is defined contribution plan? This is the feature of an defined contribution plan. What is the feature? Entity. Entity means in this case ABC. We have to answer the question from the perspective of ABC. ABC pay fixed contribution into a separate fund. That is 10% of the salary to a particular fund managed by an external party. And will have no legal or constructive obligation, nothing else, to pay further contributions if the fund doesn't hold sufficient assets to pay all employee benefits related to their service. Even though the fund doesn't have sufficient money to pay the employees at their retirement, that's not a problem for ABC. ABC's obligation is over once the funds are remitted to the particular external fund. The risk lies with the employee who may receive lower benefits than what is expected. So always the risk lies with whom? Not with ABC, not with the entity, but with the employees. This is defined contribution. The other one, so in the exam this time, it might not be defined contribution. For your examination, December 2023, it may be defined benefit. So there, what is defined? The benefit. So examples are gratuity obligation that we have in our country. Then let's say if entity promises a pension to the employees after they retire on monthly basis, there what is defined? The benefit, not the contribution. Right? So the entity's obligation is to pay the particular benefit once they retire. Gratuity amount, pension amount, after they retire, that is the responsibility of the entity. Right? So then it would be a defined benefit plan. So if anything is not falling within the definition of defined contribution plans, it's automatically would become a defined benefit plan. Examples, as I mentioned, gratuity pay. Then if entity agree, once the employee retire, pay a monthly pension up until they die. Those are what defined benefit. Right. Okay. Again, with the time limitation, I'll stop at that particular point with regard to this discussion for this question. But you have to revise your knowledge if you don't understand, or if you are finding it difficult to understand, maybe you need to go and watch the videos. Okay. Right. Okay. question now. So we have the answer to the question. Sorry, the answer to the question is this is a defined contribution plan under LKS 90. Okay, defined contribution plan under LKS 90. Good. Let's move on. Right. 1.8 or the question number 8. Read the question. This is from revenue recognition, SLFRS 15. On 1st January 2022, right, PHAC enters into an agreement with a customer to build an office building, right? So this is the date, build an office building. Contract price will depend on the project completion. So very important information, contract price will depend on the project completion time as follows, right? If completed on time, PHAC will receive 500 million rupees. If you complete as per the timeline agreed with the customer, company is going to receive how much? 500 million. If completed 1 month before the deadline, company will receive 550 million. There's a 10% chance of this happening. Okay, so there's a 10% chance where the company, that is PHAC, will complete the project before 1 month, where they will receive 550 million, right? On the other hand, if completed 1 month after the deadline, company will receive only 450 million, not even the original amount of 500 million, and there's a 20% chance of this happening. Will you understand the question? Read and understand. Read and see whether you can understand. If you complete as per the deadline agreed with the customer, you will get 500 million. If you complete 1 month before the agreed deadline, you get more, 550. There's 10% chance of this happening. Complete before 1 month. Then if you complete 1 month late, delay, then you get only 450 million. What is the probability of happening that? 20%. Which means, what is the probability? Tell me the answer. What is the probability for the first scenario? Complete on time, where you get 500 million. 10% chance of completing it early. 20% chance of completing it late. That means, what is the percentage or the probability of completing the project on time? 70%. Right? 70%. Because it has to be 100, no, the entire thing. 10% early, 20% late. That means probability of completing the contract on time is 70%. What is the question? So this question is tested from the area of variable consideration, right? So when you are applying the 5-step model of the revenue recognition of the organization, right? You have to decide, one step is to decide the transaction price. Okay, what is the transaction price for the purpose of revenue recognition under SLFRS 15? Revenue from contracts with customers by applying, very important, read the question fully, right? By applying the expected value. Okay. So now when you decide the transaction price, actually deciding the transaction price is the third step of the revenue recognition model. So if you look at the 5 steps, identifying the contract, that is the first step. Second step is to identify the distinct performance obligations within the contract. And the step number 3 is to decide the transaction price. Right. Step number 4 is to allocate the transaction price to each of the performance obligations. And step number 5 is to recognize the revenue either by using point-in-time approach or overtime approach. Now, this is the step number 3. In the step number 3, we have, complexities sometimes when deciding the transaction price. One complexity is, what do you do if we have a variable consideration involved? So this is a situation where the variable consideration is involved. Because why? Consideration can be varied depending on the situation. Right? It can be 500 million, it can be 550, or it can be 450 million. When you have this type of a scenario, what the standard says is, you have two approaches to recognize the revenue. One is expected value approach. The other one is what? Most likely outcome approach. So out of these two, you have to select the approach. Whatever the approach that you select, you have to select that, and you have to constantly follow that approach when recognizing the revenue. I'm not going to read the entire thing, right? So as mentioned, with regard to the variable consideration, you have two approaches. Whatever the approach that you have selected, need to apply consistently throughout the contract. So the two approaches are expected value method, which you're going to apply in this question. The other one is most likely outcome method. In the expected value method, what you do is you take the relevant outcome with their respective probabilities. Now, in the first scenario, it is 500 million with 70% probability. So how much is that? 500 million into 70%, that comes to 350 million. You take the outcome multiplied by the respective probability. Second outcome, 550 million. What is the respective probability? 10%, which means 55 million. And third outcome, 450 million. 450 million into 20%. That comes to 90. Right? You take the each outcome multiplied by their respective probabilities, you get the value, then you take the sum of these values. 350 minus 55, no, sorry, 350 plus 55 plus 90. How much? 495. So what is the answer? 495 million, because we follow the expected value approach to quantify the variable consideration under step number 3 of the revenue recognition model, transaction price determination. Are we clear? So this is what we did. But again, that is the past paper. For your exam, the same question examiner might ask. If entity apply, this is what we have applied. If entity apply this most likely amount method for the revenue recognition, what is your answer? So can anybody tell me what is the answer if we apply most likely outcome method? Hurry up. So in the most likely outcome method, what we look at is outcome with the highest probability, most likely. So what is the outcome with highest probability? What is the highest probability? 30%. So what is the outcome with the highest probability? 500 million. So if you apply most likely outcome method, your answer should be A, that is 500 million. Hope you are clear with that. Okay, right, going on. This is a tricky question, very simple standard, but I would say a tricky question. Which of the following is incorrect? That means 3 statements are correct, 1 is incorrect. In relation to the application of LKS 20, accounting for government grants and disclosure of government assistance. Right? So what is incorrect? Let me, obviously this question is tested from LKS 20, accounting for the government grants and disclosure of government assistance. I'm not going to go through the entire thing. This is the summary of the standard. Right? So always when you're studying, what you do is create a mind map at the end. So even my approach is actually always we understand it and thereafter create a mind map. Then you remember this mind map and you can apply that in the examination scenario. Now all the government support that you get, it can either be a government grant, government assistance, or other benefit. So to say that something is a grant, important aspect is you should receive or there should be a transfer of resources from government to the organization. in terms of cash or in terms of asset. So some sort of a resource transfer should be there. Then the particular entity should comply with the conditions. So with this resource transfer, government would impose conditions. So the entity has to comply with the conditions. Now, for example, let's say if you are a private hospital, you want to buy a machine, very costly machine for the cancer treatment. So it would cost you, let's say, 1,000 million. Government would tell that we will give you 30%, 300 million out of 1,000 million, I will give you. But you should not charge more than this amount from a patient. The maximum amount that you can charge is this. You have to do this much of scans during the year. Conditions are imposed. So the hospital has to comply with the conditions. So upon complying with these conditions, there's a transfer of resources from the government to the hospital, right? So then these grants can be either asset related, which means it is related to a long-term asset. The example what I have given is just now is a asset related government grant, because you are going to buy a equipment, machinery, or a scanning machine for the cancer treatment. So it's a long-term asset involved. It's a asset related government grant. If it is not coming under the asset related government grants, that would become income related government grant. For example, let's say government gives you money to carry out the research work of the organization. You carry out research work, government is funding part of that cost. So there's no long-term asset involved. So that is not an asset-related government grant. So it will become an income-related government grant. Then the government grants, what is the accounting treatment is you account, you recognize, you measure government grants, that is accounting, and make certain disclosures. Right? The question is tested from this area, government grants actually. Right? So because of that, I'm not going to explain you the other two, government assistance and the benefits. Just to tell you, government assistance are just disclosed, not recognized, not measured. It is not accounted, right? On the other hand, other benefits like national security, infrastructure, benefits enjoyed by everyone, not recognized in the financial statements at all. Right. So I'm focusing on this grants. Now, with this knowledge, tell me what is the incorrect answer. Can anybody tell me what is the incorrect answer? Any guesses? A grant is recognized if there's a reasonable assurance that entity will comply with the conditions and the grant will be received. Actually, this is a correct thing. To recognize a government grant in the financial statements, two conditions are to be fulfilled. Number one, there's a reasonable assurance that entity will comply with the conditions that are going to be imposed, as well as there should be a reasonable assurance that grant will be received. If the grant has not yet been received, if it is already received, that's fine. If it's not yet been received, there's a reasonable assurance that grant will be received. Just because election times ministers comes and say that okay, we give this, we give that, you can't recognize the government grant. There should be a reasonable assurance that grant will be received. Right. So the first part of the answer is correct. Answer A is correct. Second one, loan received from the government at below market rate of interest should be treated as a government grant. What do you say? Is it correct or incorrect? Let's say the market interest rates. Let's assume market interest rate. Let's say market interest rate 15%. Government gives you a loan. Government gives you a loan at a rate of, let's say, 3%. Let's say it's a 10 million worth of loan. Right? What do you do? In your financial statements, you have to, so let's say this particular loan is given for 2 years. If it is a market rate at 15, government has given you this loan at 3%. It has to be repaid in 2 years' time. What you do? What is the accounting entry that you need to pass in your financial statements? So with regard to this particular scenario, let's say at the time of receiving the loan, I'll tell you the debit entry, you should tell me the credit entry. Yeah? So where you should debit? Very simple. Cash debit. Now I told that 10 million cash debit. Tell me the credit entry. What is the credit entry? Can I say that government grant credit 10 million? No, you have to pay. It's a loan. Only thing is you have a benefit. You don't need to pay interest at 15%. You just need to pay interest at 3%. So what you need to do is there should be an entry for the loan balance. Loan is a financial liability, right? Financial instrument standard, SLFRS 9. We learned that all the financial instruments are initially recognized at fair value. I have to calculate the fair value of this loan. Why? This is a off-market financial liability. What do you mean by off-market financial liability? If the loan is given at 15%, I just need to credit 10 million to the loan because that is a market rate transaction. Let's say somebody has given me a loan of 10 million at 15% for 2 years. Then the double entry is very simple. Cash debit 10 million, financial liability or the loan credit 10 million because it is at fair value. It is a market transaction. I don't need to calculate the fair value separately. But this one is an off-market transaction. What I need to do? I have to plot the future cash flows of this loan. What are the future cash flows in this loan? I have to pay interest at 3% for 2 years. At the end of the 2 years time, I have to pay the 10 million. Take these cash flows and discount by using the market interest rate of 15%. When you do that, your fair value is definitely less than 10 million, right? Because it is an off-market transaction. Let's assume, right? I have not done the computation. Let's assume you get the fair value of, let's say, 9 million, example of 9 million. Which means the benefit that you get is 1 million. This is the government grant. This is the government grant. 1 million is the government. Right? So that means what? Answer B is correct or incorrect? Correct. Loan received from the government at below market rate of interest should be treated as a government grant. Not the full loan, but this 1 million. You have recognized the government grant in this scenario. Are we clear? Are we okay with that? Understood. Then, answer C. Grants related to assets should be presented as a deduction to the carrying amount of the related assets. Is that correct? Now remember the example that I have given. I told you private hospital is acquiring a cancer treatment machinery. So what government is giving is government is contributing for 30% of this machinery. So let's say the machinery value is 1,000 million. Government is contributing 30%. 30% means 300 million. Now, when you buy the machinery, you can say machinery PP&E debit. Let's say 1,000 million. You credit cash. How much? 1,000. Now, government is giving you 30%. That means 300 million. What's the double that you will pass? So let's say government is giving you cash 300 out of this 1,000. Where should I credit? Where should I credit? I have a choice. Either I can follow the gross approach or net approach. Gross approach means you take the grant into a separate deferred income account. Right? This is the first step. Gross approach. Gross. Then what you do is you depreciate this PP&E over the useful life. What is there in the deferred income account? You credit to the P&L over the period of time. That's what you do in the gross approach. Second approach is for the grant that I receive in terms of the asset. If I follow the net approach, so the first entry is same. This is same. You buy the asset, credit cash 1,000, debit PP&E 1,000. Then in the net approach, if I receive the grant from the government, same amount 300 million, you debit cash 300, where to credit? You credit PP&E. You credit the asset account itself. Then once you credit 300, this particular asset value 1,000 will come down to 700. You make the asset value to the net cost. 1,000 you spent, you receive 300. Net cost is now how much? 700. Then the 700 you depreciate over the useful life of the asset. So this is actually the second approach. First approach is the gross approach. Second approach is the net approach. Both methods are allowed. So that is what is mentioned in this slide. Treat the grant as deferred income and release to the P&L over the life of the asset, or else deduct the grant from the cost of the asset and depreciate the net. Now, what is the answer given here? Grant related to assets should be presented as a deduction to the carrying amount of the related asset. Is it a must? It can either be deducted from the cost of the asset, that is the net approach, or else you can consider the grant as a separate deferred. So it should not be, it's not a must to deduct from the cost of the asset. So that's why it is incorrect. It's not a must. You can avoid deducting the carrying value of the asset and keep the grant in a separate deferred income. So actually the answer is this C. Anyway, let's read because C is incorrect. It's not correct. D is a recognized grant that become payable subsequently should be accounted as a revision of the accounting estimate, which means, let's say, I told you, you recognize the government grant. You recognize the government grant upon satisfaction of you believe that I'm going to satisfy the conditions as well as grant will be received. Upon those conditions, you recognize the government grant. But later some point of time in future, you would see that, okay, it is difficult to satisfy these conditions imposed by the government. Because of that, it seems that I need to repay the grant. But you realize that after some point of time, let's say after 2 years only, you decided, now if you take the same example for this machine, government is saying that not to charge more than this. You have to do this much of scans during the year, but it's difficult to satisfy this condition. You realize that after a couple of years. At that time, what will happen? You have to repay the government grant. When you are repaying the government grant, you have to pass entries. The question is, what you have accounted up to now in the previous years. Now, let's say the first year you accounted, your financial statements are published, done. But later on, when the grant become payable, how do we account for that? Are you going to make the adjustment prospectively? That means in the second year and going forward, or else are you going to adjust that from the beginning, retrospectively? Are you going to restate the previous numbers relating to the government grant because you have passed entries? So what the standard says is whatever the adjustment in terms of the repayment of the government grants, that has to be considered as a revision of accounting estimate. Accounting estimate changes we know as per LKS 8. As per LKS 8, accounting estimate changes you adjust prospectively only. Current year and the future, you don't make any adjustments to them, you don't make any restatement to the numbers presented in the previous years. So which means answer D is also correct. Repayment of government grant has to be accounted as a change in accounting estimate, which means it has to be accounted prospectively. In the particular period where the repayment has to be made and the future, not the past year numbers are restated. So the answer to the question is what? Answer C. Right? So there's a question in terms of what this particular present valuation. So I don't have the time to explain with the numbers. Again, if I explain the concept of how to calculate the fair value, how to calculate the fair value of the financial liability, because fair value is calculated by looking at the present value of the future cash. Now, once you take a loan, you have to make the repayment. Your repayments would be interest and the capital. Take those future repayments. Now, especially interest is paid at 3%. Interest is paid at 3%. So take the cash outflows and discount these cash outflows at 15%. then the value that you get would be definitely less than 10 million. I assumed that to be 9 million. It would be different, right? It would be different when if you actually calculate the numbers. I assume that amount what you get as the present value of the future cash flows, once you discount at 15% is 9 million. Then the difference between the 10 million and 9 million is the government grant. So the benefit, subsidy that the entity entitled, because loan has to be repaid. The benefit that you get here is reduced rate, right? It's a loan, it has to be repaid. But the benefit is the subsidy. That is the difference between the market rate and actual loan rate, 15% and 3%. That subsidy, that benefit has to be accounted as a government grant. Okay, right. So answer to the question for this particular question is C. Okay, right. Okay, yet again, this question is also from regulatory framework. How, CS Sri Lanka is going to adopt the IFRSs and the IFRSs which are issued by IASB for the due process of adopting the accounting standards in Sri Lanka, right? So this particular question was tested in a different way. In the first part of the questions, yet again, there's one more question in this area. Read the question and see that whether you can answer to the question. Rather than I am telling the answer, see that whether you can do the correct answer for this. Of the following is incorrect when describing the due process for the adoption of IFRS issued by IASB as SLFRS by CS Sri Lanka. Okay, so what is the incorrect answer? Okay, what is the incorrect answer? So, yet again, so this is from the regulatory framework. Okay. So if I explain you the process, actually the last two bullet points I explained at the I explained in a previous instance. What happens is this. Now, when IASB or International Accounting Standard Board, right, issue an exposure draft. Okay, because before IASB issue a IFRS or else IAS, before they issue a new IFRS or before making a significant revision to an existing standard, what they do is they publish a draft standard that is called as an exposure draft. Or else before putting the final interpretation, let's say before putting the final IFRIC, they put a draft interpretation. Why do they do that? Because to get the comments from the public. So once they put that, CS Sri Lanka also look at that. Okay, so here IASB is issuing a new exposure draft or draft interpretation. What CS Sri Lanka does? CS Sri Lanka also need to provide their comments to IASB. So for that purpose, what CS Sri Lanka does is, CS Sri Lanka put that for the public comments. So normally once you put that into public comment, rarely people respond. So because of that, CS Sri Lanka, they know that. Because of that, what CS Sri Lanka does is, they sometimes conducted a roundtable discussion with CFOs in the particular industry. So let's say if something relevant with, let's say, apparel industry, CFOs of that particular industry, right? So, or else if it's a, not industry specific, relevant for everyone, so you get the CFOs and they organize a discussion to understand the potential impact of this particular exposure drafts. So then after getting the views, might be, sometimes CS Sri Lanka is getting the views of the main audit firms as well, right? So then what CS Sri Lanka does is CS Sri Lanka forward their views to IASB. Now in future, so once you become a CFO, what you can do is you can participate for these discussions, right? So yeah, you can provide your views to CS Sri Lanka, right? Okay. So now then thereafter, so this is with regard to the exposure draft. Exposure draft. So CS Sri Lanka now given their comments. Then what IASB does is IASB takes all these views similar to CS Sri Lanka. Other bodies around the world give their comments on these exposure drafts. So IASB consider these comments, and what IASB does is then final IFRS standard or the final IFRIC interpretation would be issued. Then once it is issued, what CS Sri Lanka does is CS Sri Lanka carries out a review once again about this final standard as well as related technical materials. So they do a review. So once they do a review, they might say that they might decide, CS Sri Lanka might decide, okay, adopt as it is with the same effective date of the standard which is getting effective when it comes to the IASB's point of view. Or else CS Lanka might decide, okay, if you have negative consequences, if you apply as it is in certain situations, very rare by the way, CS Lanka might decide to do modifications or else defer. That means you make it effective not on the same date where IASB is going to make them effective. We'll make it effective maybe a couple of years later. So that decision has to be made by CS Lanka. Adopt as it is, defer it, or are we going to do slight modification? That has to be decided. Then after making that decision, standard is getting translated into Sinhala and Tamil versions and published in the Extraordinary Gazette as it is required by Accounting and Noting Standards Act number 15 of 1995. Right? So it is getting converted to Sinhala and Tamil, and you gazette it as per this act because it's a requirement of the Accounting and Auditing Standards Act. Once gazetted, the standard becomes legally authoritative, right? So this is the process. Now the question is, what is the incorrect? Which of the following is incorrect when describing the due process for the adoption of IFRS issued by IASB as SLFRS by CS Sri Lanka? Now tell me the answer. Now you should be able to tell me the answer. Hurry up, guys. What's the answer? Is answer A correct? CS Sri Lanka forwards its view on exposure drafts issued by IASB, correct? So they forward the views of CS Sri Lanka. That's correct. Answer A is correct. Answer B, a roundtable discussion of CFOs will be held when IASB issues the final IFRS standard. Seems to be correct, but not correct, right? So this is where the examiner put you in trouble and you need to study accurately. Now you remember, let's say, studying this, you remember lecturer said that here roundtable discussion to be made with CFOs, you remember that part. But remember that discussion is held at CS Sri Lanka, at country level, not IASB, right? Here you do the roundtable discussion to get the comments for the exposure draft by CS Sri Lanka. It is not something done by IAS. So that is actually incorrect. Part B is incorrect. C and D should be correct then. No? Anyway, let's see. CS Sri Lanka review the final IFRS standard and related technical materials before adoption as a SLFRS standard. I told you once the final standard or the interpretation is received, CS Sri Lanka review it before adopting that as a SLFRS in our country. Standard is translated into Sinhala and Tamil and published in the Extraordinary Gazette. So after deciding what to do, CS Sri Lanka, so the standard is translated into Sinhala and Tamil versions and it is getting published in the Extraordinary Gazette as per the Accounting and Noting Standard Act of 15 of 1995. Then only it would become legally authoritative. Right. So A, C, and D are correct. So what is incorrect is B. So the answer to the question is B. So you see, sometimes these objective test questions are tricky. Yeah? I would say this is what now out of your paper you have section 1, 2, 3. Section 1 is very tricky. So people say that okay, you have the answer, you just need to select one answer. Yes, that's correct. But the answers are selecting. The answer is tricky. You have to read the question carefully. Okay, you have to read the question carefully. Right. So with that, actually, we are done with section 1 of your paper. Section 1 of your paper. Right. Now we need to move to question 2 of the paper. Question 2 of the paper. Right, section 1 is done. Then let's move to section 2. What we can do is, shall we have 5 minutes break? Only 5 minutes, right? You don't need to leave. You can just be there because just to be, get the focus back, because I was discussing now 1 hour and 45 minutes. So get your focus. So let's take only 5 minutes, and in 5 minutes we'll start, right? I will be starting from question number 2, section 2. Right. So before starting, there are certain questions raised. General, when you're answering, do we need to? Right. So there was some technical matter. Right. So is my voice clear? Am I audible? Right. Okay. Right. So there's a bit of a technical matter, right? So there were questions like, do we need to remember the number of the accounting standards when answering the question? General questions before I start the question number two. If you can remember, that's fine. You can mention the name or the number of the standard. If you can't remember the number, just mention the name. Now, for example, if you can't remember agriculture standard is LKS 41, what you can just mention is as per agriculture standard. You don't need to mention as per LKS 41 agriculture standard, right? So you can do that. Then there's a question about this open book examination within the 3 hours time. How do we, look at how can we use the open book material? It's very difficult, right? So because even though it's an open book examination, referring the stuff within the 3 hours time period and answering to the question would be really difficult. So that unless otherwise there's an absolute necessity, you should avoid doing that. Unless otherwise you know that okay exactly where this particular question is. This is the page number in which this answer is there, right? So right, so that's the answer. The other thing is these question papers as well as the solution for the question paper together with the examiner's comment is in the website. So you can download this exam paper solutions as well as examiner's comments in the CS Sri Lanka website portal under the students section. So worthwhile to read examiner's comments as well, right? So anyway, you look at the solutions, and in addition to that, what are the common mistakes that the students do, and what are things that you do, including your answer. Examiner's comments are included. Read that section as well, right? Okay, so by keeping those things in mind, let's now start question number two of the paper. Question number two of the paper. Right, this is the question number two. So if you look at the requirement of the question, what requires demonstrate the recognition and measurement of following items in financial statements of New Agro for the year ended 31st March 2023 as per SLFRS for SMEs compared to full SLFRS. If you are a entity, so there are two reporting formats, I would say. So the things what we learn, LKSs and the SLFRSs are relevant with the full SLFRS. That is the big book. But if you believe that you don't have, time to follow, because if you look at this big book, full SLFRSs, if you look at the disclosure requirements, you have around 3,000 disclosure requirements. But if you look at the SLFRS for SME version, that particular standard, you have about only 1/10 of the disclosures, which means only 300 disclosures roughly. So an entity might decide that. So there are restrictions on which entities where this SLFRS for SMEs can be followed. Let's say if you are an entity who is eligible to follow SLFRS for SME, you have a choice to follow the SLFRS for SME version or the full SLFRS version. Now, in this question, the question was, there are three scenarios given. You need to explain what is the accounting treatment if you apply SLFRS for SME and how it is different from if you apply the full SLFRS version in terms of the pepper plantation, in terms of the borrowing cost, and in terms of the accounting for the land. So that is the question is all about. And giving a background, now if you believe that if you select that I'm going to apply the SLFRS for SME version, you have to stick to that. You can't, pick and choose, which means for certain things you can't follow SLFRS for SMEs, and for certain things you can't follow the full SLFRS. You have to select either one of these two reporting standards. If you go ahead with the full SLFRS, so the entire thing, go ahead with the full SLFRS. If you decide to go ahead with SLFRS for SMEs, go ahead with SLFRS for SMEs, right? But one exception, that is, even if you are following SLFRS for SME, if you want, with regard to the financial instrument standard, you can follow the big book. That is the only exception. Other than that, if you follow the SLFRS for SME version, you have to follow the accounting treatment as per that. You can't, say that for this particular item only I'm preferring the big book. You can't do that. Only exception is financial instrument area. Right, that's the background. That's not important for this particular case because financial instruments are not tested. So now let's read that particular question. New Agro Private Limited is a small and medium-sized enterprise SME based in Padukka that manages a pepper plantation. They have a pepper plantation. As a capital contribution, 50 acres of land owned by the chairman of New Agro was transferred to the company in January 2020 at a market value of 2 million rupees. Now, the capital contribution was made by the owner chairman. He has transferred his land to this company called New Agro. At the date of transfer, market value of the land was 2 million, which was done in January 2020. So, which is a 50 acres land. 25 acres, that means half of it of this land was used for the pepper plantation. Only 25 acres out of 50 acres are used for the pepper plantation. That's enough of this particular company. The company name is New Agro. Then 10,000 pepper vines, that means pepper trees, are there in the plantation. Altogether, 10,000 pepper trees are there. 7,500 trees planted in April 2020, sometimes back, are capable of producing peppercorns. Now, out of these 10,000 trees, pepper vines, grown in this pepper plantation, which is there in 25 acres. So 7,500 trees planted in April 2020 and it producing peppercorns at the moment. That is mature plantation, I would say. At the time of planting these trees, New Valmo purchased plants at 150 rupees each, and company incurred direct cost of 375,000 for other items and activities such as fertilizer and irrigation. There are directly attributable cost 375,000. From September 2020, the company started harvesting pepper from these vines during 2 cycles per annum. So you start the cultivation on April 2020. Roughly took 6 months to became into harvestable stage. That is normal. And from September 2020 onwards, you started harvesting pepper from these pepper vines, and during the year 2 times you do the harvesting. That is about these 7,500 trees, which can be considered as mature plantation. Then 2,500 pepper plants were planted in December 2022, very recently. Altogether 10,000 pepper vines. Out of that, 7,500 were planted in April 2020. The remaining 2,500 were planted December 2022, which were purchased at 300 rupees per plant. Year end that we consider is actually 31st March 2023. As at 31st March 2023, that is as at the year end, company had incurred direct cost of 125,000 of these plants, which will be available for harvesting from June 2023. You see, this is not yet attained to the harvestable stage because our year end is what? 31st March 2023. So normally, according to the scenario, what we understood is it takes 6 months time to become to the harvestable stage, as these were grown or planted in December 2022. By the year end, it has not yet achieved to the harvestable stage. So the harvest is yet to be started, and we are expecting that to happen in June 2023. That means this is what immature plantation. 2,500 pepper trees still not achieved the harvestable stage should be considered as what? Immature plantation. Based on the research finding published by Agri Research Institution, a fully grown pepper vine is capable of producing peppercorns for 5 years. Now, pepper vine or the pepper tree will produce pepper for how many years? 5 years, once it is achieved to the harvestable stage. From the date of planting, it takes 6 months to start harvesting. I mentioned averagely it takes 6 months time to start the harvesting from the date where you plant the pepper tree. There's no reasonably available market price for the grown pepper vines, as there's no active market. For these pepper vines, pepper trees, there's no active market, so that you don't have a market value. No readily available market value for the pepper trees. Okay, for the pepper vines, there's no readily available market value because there's no active market. So that means it is difficult to determine the fair value of these pepper trees. Right, that is first part of the question. So shall we answer to that part and then go to the part or the second and the third explanations? So we'll do that, otherwise you'll forget what we have read. Right, so now what is the question? You have to explain that what is the financial statement treatment if this company, that is New Valmo, is a very important question, right? Each and every paper, CL2 paper, you have a question from SLFRS for SMEs. Right? You should know what is the accounting treatment as per SLFRS for SME for these transactions. And also you should know what is the difference between the SLFRS for SMEs and the full SLFRS version. Okay, right. With regard to the pepper plantation, what is, okay, so let me go to this slide where I have included the answer as well as the other explanations. If you look at the full SLFRS first, then it's easy for me to explain what is the accounting treatment suggested in the SLFRS for SME, right? If you look at the full SLFRS, applicable accounting standard is LKS 41 agriculture standard, right? So as per this agriculture standard, it says that there are two things which are covered in this standard LKS 41 if they are related to the agricultural activity, right? What are these two things? One is biological asset. What is a biological asset? Living, animal, or a plant. Now, in this case, what is the biological asset that you have? We don't have information about animal, cow, sheep. We don't have. We have information about a plant. What is that? Pepper vine or the pepper tree is a biological asset. As well as LKS 41 is applicable for the agricultural produce at the point of harvest. When you harvest pepper from the pepper farm. If I take another example, let's take an example of a cow. Cow is an animal. If you take milk, that is the agricultural produce out of the cow. So at the point of harvest, not after the point of the harvest, at the point of the harvest of that particular agricultural produce, LKS 41 is going to be applied. So in this question, this is another example where you should read the question. You should understand for what should I answer. So specifically asking the accounting treatment for the plantation only, not about the harvested pepper. Because otherwise what will happen is you spend time unnecessarily and write, or you are answering, and it won't earn any marks because the question wants us to answer the accounting treatment for the pepper plantation. But LKS 41 is applicable for two things. One is for the pepper plant, that is the biological asset, as well as the agricultural produce at the point of harvest. But in this particular question, we don't need to answer what is the accounting treatment for the pepper which is getting harvested, and subsequently how to account for this pepper that you have harvested. No need to answer in this question. But still, LKS 41 is applicable for that as well. So what is important here is then answering this part. Right. So then New Agro is managing a plantation and they have 1,000 pepper vines, right? 1,000 pepper trees. And these top, so not 1,000, 10,000 pepper trees. So altogether 25 acres land. In this 25 acres land, 10,000 pepper vines. So the pepper trees are cultivated. So these 10,000 pepper vines, so the pepper trees are considered as what? Biological asset. So it is a biological asset, which means LKS 41 is going to be applied for accounting of this 10,000 pepper vines, so the 10,000 pepper plants. Is that clear? Right. Then the next question to answer is whether these biological assets are, because in this standard it explains about two types of biological assets. Okay, two types of biological assets. One is bare biological assets. The other one is consumable biological assets. What the standard says is you should understand, okay, first of all, what is bare and what is consumable biological assets. If I take the example of a tree or a biological asset, if the particular biological assets generate agricultural produce more than once, it would be a bare biological assets. Now, in this situation, these pepper trees or the pepper vines generate pepper, generate pepper for 5 years time, right? As per the question, for 5 years, each year, 2 cycles. So which means the particular biological asset generate agricultural produce, which is pepper, for more than once. Then it is a what? Bare biological asset. That's a bare biological asset. Another example to bare biological asset, let's say fruit tree. You have a mango tree that produce mango for more than once, right? Another example, tea bush. Tea bush produce tea leaves for more than once. They are biological assets. Then consumable biological assets means you consume the biological asset itself. Example, let's say if you grow trees to take timber out of these trees, what do? You consume it at once, right? You consume the tree itself. Then the annual crops like corn, right? So you consume the particular plant itself only at once. Good example is, so I have given you two examples. A tree grow to take timber out of the tree, you consume the tree itself. Similarly, annual crops like corn, you consume the particular tree itself only once. It won't produce agricultural produce for more than once. So, two examples, corn, like annual crops like corn, and the tree that you grow to take timber are consumable biological assets. Why it is so important to understand whether a particular biological asset is a bare biological asset or a consumable biological asset is the accounting treatment for the bare biological assets and the consumable biological asset or the consumer biological asset. Some people refer this as consumer biological assets are totally different. If it is a bare biological asset, accounting is scoped out from LKS 41. What do you mean by that? Accounting to be done as per LKS 16. What is LKS 16? Property, plant, and equipment standard. Now, what is the biological asset that we have in this question? Pepper vines. 10,000 pepper vines. They produce pepper for more than once, which means that is a bare biological asset. If it is a bare biological asset, accounting to be done as per LKS 16, property, plant, and equipment standard. Right? Property, plant, and equipment standard. So what is the accounting treatment of the property, plant, and equipment standard? Initial measurement is at cost. Initial measurement is at cost. Then subsequent measurement, either you can follow cost model or revaluation model. Are we clear? Now, if I go to the next slide, I'm not going to explain the entire slide. It says that following things are scoped out, or the LKS 41 is not going to apply for the following things, where I just wanted to focus on the fourth point. You can read leisurely the first three. I don't have time to discuss the entire thing. So if you read the very last one, spend time of reading that one. It's worthwhile spending time on reading that last statement. Bare plants are used to produce agricultural produce for more than one period. Example include grape vines, like pepper vines. In this case, grape vine produce grapes for more than once. If you have a grape tree, grape vine, it produces grapes for more than once. Again, when you have tea bushes, it produces tea leaves for more than once. So these are bare plants. Bare plants are accounted in accordance with LKS 16 for the plant and equipment. Are we clear? Are we clear? Okay, right. So I'll stop from there. Right thereafter, you have some other thing as well. Again, let me read that as well, just so your knowledge, because because these are past paper. So in your paper might have been what is tested is not what is there in this paper. So if I read the sub bullet point as well, however, any unharvested produce growing on a bare plant, that means tea leaves on a tea bush, is a biological asset. It has to be accounted as per LKS 41. Now, in this particular question, pepper vine or the pepper tree is a bare plant. It has to be accounted as per LKS 16. That's true. But if you have any unharvested pepper growing on this pepper tree, as at the reporting date 31st March, you might have certain pepper which is unharvested. Those unharvested pepper is considered as a biological asset. To value those unharvested pepper, you need to apply LKS 40, which means you have to measure that at fair value less cost to sell. Measurement treatment, what is suggested in LKS 41 is what? Fair value less cost to sell. So similarly, if you have a tea bush, if you have unharvested tea leaves on this tea bush, is considered as a biological asset, and you have to apply LKS 41. right? So for this particular question, I'm limiting my answer for the pepper cultivation, pepper trees, because that is what is requested in the question. Okay, but I went one step more. That is just for you to give the understanding, right? Is that clear up now? I hope it's clear up now. I'm doing this bit slowly because a lot of people do not have the understanding about this standard because you are not exposed into this industry. So because of that only, I'm taking a bit of more time and explaining the details explaining the things in detail, right? Okay, right. So then moving on, then how to do the accounting? So what we are discussing, accounting treatment as per LKS 41, full SLFRS. As such, we decided now 10,000 pepper vines are bear a biological asset, so that I need to apply LK 16. LK 16 means property, plant and equipment standards accounting treatment. Now, as per the property, plant and equipment accounting standard, we know that initial measurement is at cost and the subsequent measurement is at cost or revaluation model. Now, when it comes subsequent measurement, you have a choice, right? Cost or revaluation model. But look at the hint given in the question. Look at the hint given in the question about the subsequent measurement. Look at the very last sentence. There is no readily available market price for the pepper vines as there is no active market, which means what? Subsequent measurement should be at cost, right? You don't have a market for the pepper trees. You don't have a market for the grown pepper vines, which means you can't apply the revaluation model. Most probably, which means you have to apply the what cost model, which means pepper vines, pepper trees are a bare biological asset. You have to initially measure at cost and subsequently also you need to apply the cost model. What does that mean? Cost minus depreciation. Cost model means what? Cost minus depreciation. What is the period of depreciation? Look at this one. So what it says, fully grown pepper vine is capable of producing pepper corn. So how many years? 5 years. You take the cost, that capitalized cost, you depreciate over how many years? 5 years. That should be the accounting treatment, right? Then for people now, if I read it, therefore the company can apply the cost model. Okay, cost model. From the date of planting to 6 months, now altogether, how many trees are there in this? So how altogether, how many trees are there? How many pepper trees are there? 10,000 pepper trees are there. Out of that, 7,000 pepper trees are in harvestable stage, right? Which was cultivated sometimes back. And 2,500 pepper trees are not achieve the harvestable stage. So as per the standard, especially in case of a plantation, what you do is when you're presenting the biological assets, especially trees, now in this case pepper trees, when you're presenting it, you have to classify into two categories. One is immature plantation, one is mature plantation. According to the question, to achieve the harvestable stage, it takes 6 months time. That means whatever the pepper trees which are within the first 6 months period, you have to consider as immature plantation. And whatever the trees which already achieve the harvestable stage, you have to consider as mature plantation. And the other thing that you remember is bear a biological asset for which LK 16 is applicable. So in this case, cost model is applicable. Are getting depreciated only once it is achieved the harvestable stage. In other words, immature plantation, there's no depreciation because harvest is not yet started. What is getting depreciated is only the mature plantation. Remember that. Do you understand the point? If I repeat again, immature plantation means it has not yet been achieved to the harvestable stage. So because of that, there is no depreciation. Right? 6 months period. Mature plantation means these have achieved the harvestable stage. It generates economic benefits. So those are getting depreciated over 5-year period, right? Okay. So now if I read it, what it says, from the date of planting, 6 months, they need to be considered as immature plantation. During the 6 months period, it has to be considered as immature plantation. Then after 6 months only, they become mature plantation. Therefore, 7,500 pepper vines need to be identified as mature plantation and 2,500 as immature plantation. Then very simple. So if you look at the mature plantation first, there are 7,500 trees. So to calculate the cost, you have been given, now as per the question, you have been given at the date of acquisition. We read the question. Value of one pepper vine was 150 rupees. You take 150 rupees multiplied by 7,500. You get how much? 1,125,000. Then the cost directly attributable in terms of the irrigation work, in terms of the fertilizer and all that, as per the question, 375,000. You add that to the cost of the asset, then you get the total cost. What is the total cost? 1,125,000 plus 375,000, 1.5 million. So where did I get this data? It was there in the question over here. Here, 150 was the price of one pepper tree, and this was started in April 2020. Now today is 31st March 2023, right? So you started, you have cultivated over here. So the price per pepper tree was 150. That into 7,500, we have taken the value. To that, you add the direct cost of fertilizer and irrigation, directly attributable cost, right? Then it has achieved the harvestable stage in 6 months' time. It was cultivated in April 2020, achieved the harvestable stage in September 2020. From that date onwards, you can depreciate the mature plantation. That means actually, if you look at the time period up until 31st March 2023, right? 2.5 years, right? September 2022, 31st March 2023, 2.5 years, you have to record the depreciation, because according to the question, so you can get the harvest for how many years? 5 years. But remember, you should start depreciation only after it achieve the harvestable stage. That is 6 months after the cultivation. So the total cost is 1.5 million. Then depreciation per annum, you can mention how to calculate that. 1.5 million is the total cost. Divide that by 5 years. Then you get 300,000 per annum. So the per annum depreciation would be 300,000. If you need the specific exact number as at 31st March 2023, you can take 300,000 per annum, 2.5 years, 300,000 into 2.5 years, 2.5. You can say that this is the total accumulated depreciation. Are we clear? Are we clear? Right. That is about the mature plantation, 7,500 pepper vines. Why we are applying the cost model? Remember, because this is a bearer plant. Bearer plant means accounting has to be done as per LKS 16. You are not going to apply LKS 41, because LKS 41 accounting treatment is what? Fair value less cost to sell. But as it is a bearer plant, I'm not going to do that. I have to account this as a PP&E. Right? Then what about the immature plantation? With regard to the immature plantation, these trees were cultivated very recently, December 2022. It has not yet achieved the harvestable stage. 2,500 trees. If you look at it, 2,500 pepper plants planted in December 2022. What is the per plant price? 300, and directly attributable cost were up until the year end, it got 125,000, and they are becoming the harvestable stage only after the year end. That's why we consider these as immature plantation, not achieve the harvestable stage. Cost is 2,500 into 2,500 plants into 300 rupees, 750,000. Directly attributable cost 125,000. This has to be immature, right? Not mature. This has to be cost of immature plantation altogether 875,000. You don't depreciate this because why? It has not yet achieved the harvestable stage, so that you don't start depreciation. So what happens is, once these 2,500 pepper plants or the pepper trees or the pepper vines, once they achieve the harvestable stage, what do you do is you make a transfer from where to where? From immature plantation to mature plantation. Once you transfer from immature plantation to the mature plantation, upon becoming this is harvestable, then you start depreciating the particular pepper trees or the pepper vines over 5-year period, which is the useful life of the pepper trees. Okay, so that's it. So the last para, you can read it. I have actually explained about capitalization of the directly attributable cost, because that's a cost incurred to bring the asset to the location and condition necessary to be used in the manner intended by the management. I have explained that. That is about LKS 40. But is that the requirement of the question? No, the requirement of the question is to explain what if we apply the full SLFRSS, that is LKS 41, that part we have discussed now. And what if this entity applies SLFRS for SME? Is there any difference? Now we need to look at, for the same pepper plantation or the same 10,000 pepper vines, if entity adopts SLFRS for SME version, is there any difference? So this is the SME version. Actually, I have taken directly this from the SME standard itself, right? So I said that during the exam time, you don't have time to refer all these things in this. Even though it's an open book examination, you might have the SLFRS for SME standard, but unless otherwise you know exactly where it is located, very difficult for you to refer it. Waste your time in the examination, so that you need to have the understanding about it. You should remember what is the accounting treatment book. Right. So as SLFRS or SME standard, actually this is coming under the specialized activities section. It talks about 3 specialized activities. What is important for us in this question is the agriculture. In addition to that, it talks about extractive activities like mineral and the service concessions, which is not relevant for this question. So what it says in terms of the agriculture, if I read it, entity using this standard, that means SLFRS or SME, that is engaged in agricultural activity, shall determine its accounting policy for each class of biological asset. So for each class of biological asset, now you have one class here. What is the class? 10,000 pepper vines. You might have another class. Let's say you are growing certain trees to take timber out of this. Then you might have certain cattle, dairy cattle. That's another class. So for each class of biological assets, you need to decide what is the accounting treatment. That is what is mentioned in SLFRS for SME version. Okay, so to decide your choice, these are the guidelines. What is the guideline? Entity shall use fair value model. Shall use means, shall means what? In an accounting standard, if you see the word shall, that is a must. May means you have a choice, but here shall. Entity shall use fair value model. Right, in paragraph so and so. For those biological assets, pepper trees are a biological asset. So you must use the fair value model, for which fair value is readily determinable without undue cost or effort. What it says, if you have a biological asset in which fair value can be readily determinable without undue cost or effort. You must use the fair value model. But what is the problem that we have in this question? If you look at the question, look at the last sentence over here. There's no readily available market price for the grown pepper wines as there's no active market. Now, as per the SME standard, this is a situation where I don't have a readily available fair value. You can't determine in the fair value without undue cost or effort, isn't it? Because for you to use the fair value, you should be able to determine the fair value. It is to be readily determinable without undue cost or effort. It is not the case in this situation. You can't determine in the fair value. If so, if you can't determine in the fair value, then you go for B. What is B? Entity shall use the cost model in paragraph so and so for the other biological assets. So this means you are applying SLFRS or SME version. It says it must use the fair value. If it is readily determinable, it is not readily determinable. In this question, it is not readily determinable. You can't determine the value of the pepper trees readily. There's no active market for that. Then what you should do is you need to apply the cost model. For this class of biological asset, for these 10,000 pepper trees, you have to apply the cost model. Cost model means the same cost model what I discussed earlier. Because even in LKS 41, full SLFRSS, even what I did, I have applied the cost model, isn't it? Cost model, initial measurement is at cost. Subsequent measurement in full SLFRSS, I had the choice, cost or revaluation model, but we decided I can't use the revaluation model. Even in the full SLFRSS, I measured this at cost. So, which means there's no change in the accounting treatment in the LKS 41, that is the full version, as well as LKS 41 and the SLFRS for SME. If I read it, therefore, the company can apply cost model for these assets under full SLFRS as well as SME version as well. As such, there's no difference in the accounting treatment applicable for the pepper plantation as per SLFRS for SME and the full SLFRS. So basically, same value what you have derived for the mature plantation and the immature plantation would be there even if you apply SLFRS for SME version. Same as what we have done, what we did accounting for LKS 16 cost model for the bearer biological asset as per LKS 41. Are we clear now? Do you understand? But the logic is different, right? Ultimate number is same, but how that number is derived, logic I have explained in both ways. If it is full SLFRSS, LKS 41, what is the guideline? Step by step, I have explained. Then if it is SLFRS or SME, this is the guideline. Then we derive, okay, cost model. Initial measurement is at cost, subsequent measurement is also at cost. Right? Yeah. So no difference in the numbers. Right. Then let's go to the that is the most complex part of this question, right? Paragraph number 1. For that we have answered. In addition to that, you have to look at paragraph number 2 and 3 as well. There even you have to explain what's the difference between full SLFRS application and the SLFRS for SME application. Read the second paragraph and see that whether you can answer. That's a very simple and straightforward. No complexity at all. Can you answer to that? It says company pledged 50 acres of land in February 2020 to obtain a bank loan of 1 million rupees to start the pepper plantation. Now, there's a land of this particular company belongs a land which was initially transferred by their chairman. So this 50-acre land was kept as a security to obtain a $1 million loan. Okay, to start the pepper plantation. That was done some time back. The loan is repayable in 36 monthly installments and the interest rate is fixed at 4%. So it was 36. That means loan is to be paid in 3 years' time, right? So 36 monthly installments and the interest rate was 4% annual. Interest expense for the year end. Interest expense for this year was 31st, that is for the year ended 31st March 2023 was 50,801 rupees. So what's the what is the standard or what is the applicable area that we are talking about here? Can you tell me? What's the area in which our answer should be based? Borrowing cost, right? Borrowing cost. What if you apply full SLFRSS, what is the applicable standard for the borrowing cost? LKS 23 borrowing cost. What that standard says? What that standard says? If you incur borrowing cost in terms of a qualifying asset, okay, if you incur borrowing cost or the borrowing cost directly attributable for the acquisition, construction, or production of a qualifying asset, such borrowing cost can be capitalized, include within the asset cost. Other borrowing costs, other than that, you charge to the P&L. Then we need to understand what is a qualifying asset. Qualifying asset means asset which necessarily takes substantial period of time to get ready for the intended use. Now the question is, what do you mean by this substantial period of time is not defined in the standard. Now in this situation, what can be the qualifying asset that we are talking about? Pepper tree, right? Now to achieve the harvestable stage, it takes 6 months of time. It's a substantial period of time to get ready for the intended use. Intended use is to achieve the harvestable stage. Now, as per full SLFRSS, by applying LKS 23, if you incur borrowing cost, right? If you incur borrowing cost in terms of this cultivation of pepper trees, before it becomes the harvestable stage, which means at the stage of immature plantation. Immature plantation means it has not yet achieved the harvestable stage. During that period, whatever the borrowing cost that you incur, you can capitalize. The other borrowing cost you need to expense, right? As I mentioned, based on the time taken to grow the pepper plants, the plantation may be considered as a qualifying asset. Immature plantation, more specifically, can be considered as qualifying asset, and the borrowing cost can be capitalized. Okay, once it has become to the mature stage, you can't capitalize, right? Because then it produced the harvest. It has achieved the harvestable stage. Up until it is achieved to the harvestable stage, more specifically during the time period where the plantation stay at immature plantation stage, if you consider these pepper trees as a qualifying asset, because it takes 6 months time to become to the harvestable stage, you can capitalize the borrowing. Other borrowing costs are expensive. That is LKS 23 full SLFRSS. What it says in the SME version, very simple. Whatever the borrowing cost, you expense to the P&L. It doesn't matter whether it incurs for a qualifying asset or not. That qualifying asset story is not there in the SME version. As per SLFRS for SME, entity should recognize all borrowing cost as an expenditure in the profit. Right now, there's a discrepancy, right? So accordingly, any borrowing cost incurred in respect of the pepper plantation need to be charged to the P&L here. You don't need to worry whether it is with regard to qualifying asset acquisition, construction or not. Entire thing you charge to P&L. So because of that, entire borrowing cost incurred for the year end 31st March 2023, 15,801 as per the question, you charge the P&L. So that's the difference, right? So there's a slight difference in full SLFRSS. and the SLFRS for SME standard. Right. Let's now move to the third para of the question. So we have answered these two. Now the third para, you have to explain the difference in the accounting treatment of land. Let's read that. Balance 25 acres of land, because the total extent of the land is 50 acres. Out of that, 25 acres are used for the pepper cultivation. Then the balance 25 acres, which is not used for the pepper plantation, is rented out to a company to conduct a public market in areas every Sunday and Thursday. It is rented to someone else. During the period 2020 to 2023, there were no land sales transactions that took place in the area. For no period, no transactions were taken place in the area. What is the indication? It is difficult to determine in the fair value. You don't have an active market for the land. Right? That's the indication here. Right, tell me, what's the standard? There are two standards actually. One is property, plant and equipment standard. Other one is investment property standard. You have to apply both, right? Because why? This is the common mistake a lot of people do. A lot of people apply the standard only for the 25 acres of land, which is rented to an outside party, and they forget about the main part of the land. The main part of the land. I would say the main business is what? Cultivating pepper. So 25 acres of land is used to cultivate pepper, and 25 acres of land is used to rent it to an outside company. So you have to explain about the accounting treatment for both these parts. Are we clear? Right. So what do you say about the, let's apply the full SLFRS first. What do you say about the 25 acres of land that you use for the pepper cultivation? That is definitely property, plant and equipment. Because why? You can't apply LKS 41 for that, right? If I go back and show you some one important aspect, another important aspect. Here, hope you can remember this slide. So this slide explains scoped outs of LKS 41. That means LKS 41 is not going to apply for the things what is there in this slide. Okay, LKS 41 does not apply. Look at the first one. Land relating to the agricultural activity. It is treated as a tangible non-current asset accounted as per LKS 60. So land. So in this case, land used for the pepper cultivation is not accounted as per LKS 41. It has to be accounted as LKS 16. Fair enough, right? That's a PP&E. Right? That's a PP&E. So how do we account for that? To apply the cost model, because what is the initial measurement is at cost. PP&E is initially measured at cost. The subsequent measurement, PP&E, either cost model or evaluation model. But according to the question, no land transactions have been taken place for the last 3 years, which means there's no active market, which means it is difficult for me to apply the revaluation model. So it says that subsequently, even this particular land has to be measured at cost. As it is a land, there's no depreciation, just the cost, right? Then, okay, if I read it, land used for the pepper plantation is property, plant and equipment. That's fine. Then land that has been rented out to the third party. So the land that was rented out to the third party should be considered as what? Investment property. Because we learned as per LKS 40 investment property standard, if you have a property that is land, building or both, your purpose is earning a rental income or capital appreciation, that has to be considered as investment property. In this case, purpose of having this land is to earn a rental income. So the remaining 25 acres of land, which earns rental income by providing that to an outside party, is an investment property, right? That's clear. Then, if I talk about the that is a cultivation part of the land. what you consider as PP&E. Okay, so wherever the pepper cultivation is done, that is PP&E. Then rented to the third party, you consider that as investment property, right? First of all, let's take the land used for the pepper plantation. Now, what it says in LK 16, initially measured at cost, subsequently cost or evaluation model. That is as per LK 16. But subsequently, as you don't have active market, you need to apply the cost model. Similarly, in the SME standard also, you have the same accounting treatment, no difference. Initial measurement is at cost, subsequent measurement is at cost or evaluation model. So if I go to the next slide here, it is about the LK16 full SLFRSs, PP&E is initially measured at cost. Then the subsequent measurement is at cost or the evaluation model. Cost model means cost minus the depreciation. As it is land, there's no depreciation. Revaluation model means you revalue the particular PP&E at the reporting period, and the revaluation gains and the losses are taken to the other comprehensive income. Then this revalued amount you depreciate over the remaining useful life of the particular PP&E. Yet again, as you don't have as is a land, there's no such thing called depreciation. And also you can't apply the revaluation model because why? For the last 3 years, there were no land sales in that area, so which means there's no active market and there's a problem of determining the reliable fair value. That is as per full SLFRS standard. Now, as per SMB, also you have the same accounting treatment, which means initial measure at cost. Subsequently, you have a choice, cost or revaluation model. Even though you have a choice, you can't apply the revaluation model, which means you have to stick with cost model. Under both SLFRS for SME and full SLFRS, I'm reading the second para, entity has the option to use the cost model or revaluation model for the subsequent measurement of land recognized as PP&E. Right? No difference in the accounting treatment. Then what about the remaining part of the land? What do you mean by the remaining part of the land? What is used as the land area, 25 acres, to be rented out to an outside party? If you look at the accounting treatment as per full SLFRSs, you have to apply LKS 40 investment property standard. Investment property standard says that initial measurement should be at cost. Right? Initial measurement is at cost. Subsequent measurement, you have a choice. Either you can follow the cost model, which is same as the cost model in LK16, cost minus depreciation minus impairment process, or else you can use the fair value model. Value model means that you don't depreciate. You calculate the fair value of the particular investment property at the end of each year, and changes in the fair value you take to the profit and loss. If the fair value increases, that fair value gain you can take to the P&L. No depreciation. And if lot of companies, if they have investment properties, they take this choice. It's a choice. You can either use cost model or fair value model, but you like to use fair value model because why? Unrealized fair value gains, you can take the P&L. And also no depreciation. Right? But if you follow the fair value model, there can be a situation you can't reliably determine in the fair value. Let's say you have, if I take an example, let's say you have 3 lands. So you apply the fair value model because you want to take the fair value gains into the P&L. 2 lands are in urban areas where you can reliably determine in the fair value. No issue of determining the fair value. But 1 land is in a rural area where you are struggling to find the fair value of this particular land. Now, your model is fair value model. You have to apply the choice, whatever the model that you have selected, either the cost model or the fair value model for all the investment properties that you have. But you have a problem because the land in the rural area, you can't reliably determine in the fair value. In that situation, what you can do is you can claim the exemption and measure that particular land at cost, because why? You can't determining the fair value on ongoing basis. You can't reliably determine the fair value of the land on ongoing basis. But your model is fair value. As you have a limitation, the two lands what you have in urban areas, you measure it at fair value, but the land what is there in the rural area, by claiming the exemption, by explaining that I can't reliably determine in the fair value, you can keep that at cost. Otherwise, you have to apply the same model for everything, either the cost model or the revaluation. Sorry, either the cost model or the fair value. Right? So that's why I mentioned apply the choice to all investment properties. Now, apply to this particular scenario. Apply to this particular scenario. It's so this 25-acre land which was rented out to an outside company's investment property. I have a choice. Either I can use the cost model or the fair value model. What do you say? What do you say? Which model that the company would use? Which model would the company use? Even they like to use the fair value model, can they use it? Can they use it? They can't, right? Because why? What is the reason? What is the reason? Look at this statement. Last para, during the period of 2020 to 2023, there were no land sales transactions that took place in the area. That means you can't reliably determine the fair value. So even though they want to use the fair value model, they can't determine the fair value, which means anyway this has to be measured at cost. Is that clear with you? If they select the cost model as the subsequent measurement model, no issue at all, cost model. But even if they select the fair value model, there's a problem of determining the fair value on reliable basis, so that it has to be measured at cost. Ultimately, it would be measured subsequently at cost. Right? This is as per LKAS 40, which means full SLFRS. Now, what we also need to explain, what could be the accounting treatment as per SLFRS for SMEs. In the SME version, what it says. In the SME version, this is simplified because that's why it is called as SLFRS for SMEs, right? So the certain choices, what is there in the full SLFRS have been taken out when it comes to the SME version. Which means SME version is very simple. What they say, this is what they say. Look at the first bullet point. Investment property should be measured at fair value. There's no choice as this in the LKS 40 full SLFRS, you have a choice, but in the SME version, there's nothing such that investment property should be measured at fair value if the fair value can be measured without undue cost or effort. Again, the problem is, can we measure the fair value without undue cost or effort? Can we? We can't, right? Because there were no transactions in the last 3 years. So otherwise, the cost model is actually this part for investment properties in the SME version. And if I go to the biological asset as per SME, okay, this particular part is the same thing, right? So even in terms of the biological assets, what SME standard says, you measure the biological assets at fair value if the fair value is readily determinable without undue cost. If you can determine in the fair value, you measure it at fair value. If you can't determine in the fair value without undue cost or effort, then you measure it at cost model. Same thing is applicable for the investment properties as well in the SME version. It has to be measured at fair value without undue cost or effort. Then it has to be at fair value. Otherwise, you use the cost model. Cost model means what? Cost minus depreciation. As it is land, there's no depreciation. So based on the difficulty to identify the recent transactions in the area under both SLFRS for SMEs as well as under full SLFRS, company has to use the cost model as the subsequent measurement model of the investment. It's a very good question, right? So a bit of a complex question as well, because the in the previous papers, even though this area was tested, not that complex as this. So this particular question is a bit complex, but it's a good question for you to understand the entire logic, right? In relation to these areas, what was questioned in the what it was questioned in this particular paper. Right. So the cost model means cost minus depreciation, right? But in this case, why you don't have a depreciation? Because it's land. Because land has what you can't say this is the useful life of the land. It's unlimited. So that's why we are not depreciating. Otherwise, cost model means what? Cost minus depreciation minus if there are any impairment losses, that also has to be deducted. Right? Okay. Fine. Moving on. Right. So we have answered to second question as well. That is with in section 2, question 2 we have answered. Okay, so the third question is mainly again from an accounting standard related question. So this is from the case 36 mainly. So what we can do is like earlier, so let's take 5 minutes break. After the break, we can start, right? So I'll discuss this question as well. So 5 minutes. So don't go anywhere because it's a very important question yet again to understand the entire concept of LK16. So we'll discuss in Right. So let's start. If you look at the requirement of the question, right? So if you look at the requirement of the question, based on the information available, recommend whether an impairment test is required for following CGUs, cash generating units, for the year ended 31st March 2023, right? So the now this particular question is from LKS 16. Now, if I explain you the background, so what the standard says is apply the standard for individual assets if possible, each and every asset. But practically it is difficult and cumbersome. So because of that, what entities does is they group their assets into cash generating units, which is a smallest identifiable group of assets which generate cash inflows which are independent from the other groups of assets. So you group your assets, and once you group your assets, you consider that as a cash generating unit, and you apply the requirement of the standard for that particular cash generating unit. Now, as per this question at the year end, so you have three cash generating units: medical equipment unit, hotel unit, and the automobile unit. So the question wants us to explain what is your recommendation with regard to the impairment test, whether an impairment test is required for these three cash generating units for the year ended 31st March 2023 or not. So that is the first part of the question, part A of the question. Part B, based on the information available, propose how the impairment loss of the transport unit, there's one more unit, transport unit, should be allocated as at 31st March 2023. How to do the impairment loss allocation, right? So these are the two parts of the question. By keeping it in mind, let's read the question. Okay. Before reading the question, always my advice is for you is to read the requirement. Then when you read the question, you can plan your answer. You know the requirement now. So now read the question. Finance team of XYZ Private Limited, XYZ, is in the process of finalizing the financial statements for the year ended 31st March 2023. They are currently discussing the following matters, right? Impairment indicator assessment. Accountant has gathered information about following cash generating units. So the accountant of the organization has gathered information about the following three cash generating units, right? So before reading the information about these three cash generating units, because what we conclude, for each cash generating unit, do we need to conduct an impairment test or not for the year ended 31st March 2023, right? So before reading it about this, because here in this company XYZ, there are three cash generating units, and accountant has gathered following information about each of these three units. Before reading the specific information, let me go to the standard and explain to you how to apply the standard in very brief, right? Not the full explanation. Then you can, then and there say that, okay, this is the application of the standard for this particular cash generating unit. So this question is from LKS 36 impairment of asset standard, right? So first of all, you should understand this standard is a general asset impairment standard. What does that mean? Because there are specific impairment provisions of assets are discussed in relevant standards. What does that mean? Which means the particular asset is there in this list, you have specific impairment provisions in those standard itself. So because of that, you are not going to apply this general asset impairment standard, which means LKS 36 for the assets what is there in this list. So that's the first thing that you need to understand. I'm not going to go through the full list, but let's take one or two examples that you're familiar. Let's take inventory. For inventory, you have a separate accounting standard. What is that? LKS 2. As such, What is the subsequent measurement of inventory? Cost or net realizable value, whichever is lower. So if the net realizable value is lower than the cost, there will be a write-off. Right. Now that is what is mentioned in the inventory standard. Then do we need to separately apply LKAS 36 for the inventories? No need, right? Because why? If the NRV is less than the cost, already inventory is written off as per LKS 2. Then you don't need to apply LKS 36 separately for that. So that's why it is scoped out. Inventories are scoped out from LKS 36. Similarly, let's take financial assets. Data, receivable, trade receivable is a financial asset. There are so many other financial assets. Impairment of financial assets are discussed in SLFRS 9. There's a separate section in SLFRS 9. So there's a model called expected loss model. So if there's any impairment for the financial assets, you recognize the impairment loss as per this expected loss model. There are certain simplifications, but as per SLFRS 9. Then after applying SLFRS 9 impairment provisions, do we need to apply the impairment provisions of LKS 36 for the financial asset? No need. So because of that, financial assets are scoped out from this general asset impairment standard LKS 36. One more, right? I'm not going to explain everything, but anything what is there in the list, the same rule as we discussed investment properties. If you have any investment properties measured at fair value, subsequently, which means you are fair valuing the property, fair value gains and the losses are taken to the P&L. So it is getting fair valued at the end of each reporting period. If you have a fair value loss, it is accounted as per case 40. Then do we need to come back and apply LKS 36 for the investment properties measured at fair value again? No need. If there's a fair value loss, it is accounted already under LKS. So that's why what is there in this list is scoped out from LKAS 36. So the first thing that you need to understand is if something there in this list, don't apply the general asset impairment standard for those, right? Okay. Other than those they are in this list, for all the other assets, you need to apply this general asset impairment standard. Can you give me examples where certain assets, where this, what is there, what is not there in this list, where the general asset impairment standard is applicable? Can you ever tell me examples? General asset impairment standard is applied with regard to the impairment. What is not there in this list? What are they? Hurry up, very simple. Any examples? Can you think about it? Property, plant and equipment, not in the list. Intangible assets, not in the list. So for those property, plant and equipment, intangible assets, in relation to the impairment, you have to apply this general impairment standard, which is LKS 36, impairment of assets. Right. Now we are discussing how to apply the standard. First of all, you need to look at, for these assets which are covered by LKS 36, are there any indicators of impairment? Indications of impairment. Indication means that evidence of impairment. Impairment means that in layman's language, value reductions. Are there any permanent value reductions? So what are the evidences? These evidences can be external sources, external to the entity, or internal sources, internal to the organization. Again, I'm not going to explain the entire thing, but if I give an example for the external source of evidence, think about you have machinery. Now the emission levels are high. Government has enacted strict environmental regulations. As per these regulations, you can't use this machinery without a significant modification. You have to incur a huge cost to modify. Kind of what? Impairment indicator in the external regulatory environment. Right? Think about the machinery where this company, Nokia, so the famous mobile phone company, right? Everybody was using, Nokia phones sometimes back. I would say maybe 15, 20 years back, they were using Nokia mobile phones. The machinery used for the production of the Nokia mobile phones at that time was useful. But then with the technological and advancement, iPhone and the Android technology, So others have captured the market. Now the assets that were there with the company. Now what has happened? External environmental changes. So it's a kind of what? Indicator of impairment. Then internal sources, which means let's say there's a fire, asset got physically damaged. It's an evidence indicator. There can be a value reduction. So first thing is to look at, with regard to the assets which is covered in this standard, are we have any external or internal impairment indicators, right? If you have indicators, then you go for the second stage, that is impairment assessment or impairment review or else impairment testing. Same thing, huh? Examiner might use impairment testing, impairment review or impairment assessment. It is the same thing. So you go for this step only if you have indicators. Let's say you have 1,000 assets of the organization. Out of these 1,000 assets, you decide 990 assets, no indicators are available. Then that means you don't need to perform the impairment testing for these 990 assets because it's a waste of time, no need. But 10 assets, you realize there are external or internal indicators are available. So then these 10 assets, you go for the second stage, which means what? Impairment testing stage. So the question that asked is from this particular area. So there are 3 cash generating units. Are we going to do the impairment testing or not? Now we know how to approach the question, right? So up to now, what we know is, okay, if you don't have any indicator, no impairment testing, but if you have indicator, you have to do the impairment testing. In impairment testing, what you compare carrying value with the recoverable value. So carrying value means a book value, balance sheet value, that you know. Recoverable value means when you have an asset, you have only 2 ways to recover the value of the asset. What are the 2 ways? Use the asset within the business and generate the future cash. To calculate the value, you calculate the present value of the future cash flows that you can generate by using the asset and ultimate disposal. You derive the cash flows, discount by using the relevant discounting factor and get the present value. That is called value in use. Right? Let's say you calculate value in use is 900 for a particular asset. That is one way of recording the value of the asset. What is the other way of recording the value of the asset? You dispose the asset immediately. If you dispose the asset immediately, what you get is the fair value less cost to sell. Right? You are not going to use it continuously in the business. You just dispose it. Then you get the fair value. From that, you deduct the selling cost, fair value less cost to sell. Let's say this is 860. Then if you are a rational person, when you have this scenario, what are you going to do? Are you going to continue to use the asset in the business and generate future cash flows, or are you going to dispose it immediately and recover the value? You will continue to use it, right? That's why the recoverable value is the higher of these two, because you have the option. You have the option to continue the asset and generate future cash flows, or else you just dispose the asset. So what is the recoverable value here? 900. 900. Then you compare that recoverable value with the carrying value. Let's say carrying value is 1,000, recoverable value is 900. Then no point of keeping 1,000 in your balance sheet as the asset value. You have to bring the asset value down to 900. So by recognizing an impairment loss of how much? 100. So in this case, what is the impairment loss? What is the impairment loss in this situation? 100. Because carrying value is higher than the recoverable value, you can't keep the asset more than the recoverable value in your balance sheet, recognized an impairment. Is that clear? That's what you do. But again, I'm reminding you, do this step only if you have indicators. If you don't have any indicators, don't waste time on this. But there are 3 exceptions to this general rule. What do you mean by exceptions? What do you mean by exceptions? What is the normal rule? To conduct the impairment testing only if indicators are available. That is the normal rule. But there are 3 exceptions to this normal rule, which means These three assets, what I'm going to discuss now, must be tested for the impairment on annual basis, even though there are no indicators available. Irrespective of the availability of the impairment indicators, you must test these three assets for the impairment, right? So all these three assets are actually intangible assets. So let's see what these three assets are. Cash generating units to which goodwill has been allocated. When you have a cash generating unit with goodwill figure, you must test that particular cash generating unit for the impairment. What is the reason? What would be the reason? Because goodwill is an intangible asset which is not getting amortized, right? That means always there's a risk of overstating the value of the goodwill, so that it's a must for you to do the annual impairment test. Right? What's the second one? Intangible asset with indefinite useful life. What do you mean by indefinite useful life? Normally, intangible assets are getting amortized over the useful life. But let's say you acquire a brand from someone else. You purchase this brand and you believe that it's a very valuable brand. I can take the benefits for an infinite period of time, indefinite period of time, so that I'm not going to amortize. So yet again, you are not amortizing means always there's a risk of overstating the asset value. So that what you need to do? You must test the particular intangible asset which has an indefinite useful life, or else you are not amortizing for the impairment testing on annual basis. That means you have to do this check on annual basis. If you are not amortizing the indefinite useful life intangible assets. That's the second one. Third one, intangible assets not yet available for use. That means it is not yet generating any economic benefits. It is still in the development stage. You may heard or you may have learned definitely the internally generated intangible assets, research and development stages. Normally, you can't capitalize the internally generated intangible assets, but if it goes through this process, research and development, whatever the cost that you incur in the development phase of the intangible assets, you can capitalize. It is in the development stage means it is not yet completed, right? You are doing an experiment, but it is in the development stage. Once the development phase is over only, you start amortizing the particular intangible asset. Now, at the moment where it is in the development stage, we can say that that particular intangible asset is an intangible asset which is not yet available for use. As it is not yet available for use, you are not amortizing it. You are not amortizing it means always there's a risk of overstating the value of that particular intangible asset. So that what you do, you must subject that particular intangible asset for the annual impairment testing, irrespective of the availability of the indicators, right? So which means these three assets, it's a must for you to do the annual impairment testing. This annual impairment testing can be done at any time during the year, right? But it has to be consistent. If you do it at the year end, do it at the year end. If you do it at maybe on 30th September each year, do it on 30th September, right? It has to be consistent, right? If you want to do that on your birthday, that is also consistent, right? Do it on your birthday, but it has to be consistent, right? But most of the entities do that at the year end, right? Because the reason is, if the now what it says is annual impairment testing is a must. By doing the annual impairment testing, if you have an impairment indicator at the year end, again you have to do the impairment testing. That is the normal rule. No? Normal rule is what? If you have impairment indicator, do the impairment testing. But these three assets, even though you don't have any indicators, you must do the annual impairment testing. So most of the entities, what they do is they do the annual impairment testing at the reporting date. Because why? Otherwise, sometimes if you do the annual impairment testing on some other date, at the reporting date, if you have indicators, you have to do it twice during the day. Right? Okay. At each reporting date, if impairment indicators are available. And this is the summary. So understand this summary. This is what I said, that in any standard, what you do is you have to create a mind map by your own. Now, all the things what I have explained up to now, you can put that into a diagram like this, then you can understand it. You can remember it. You don't need to learn by it. So always, I'm teaching, what I do is, okay, teach and thereafter create a mind map. There's a mind map for this. There are three assets with exception. What is that? Cash generating units with goodwill, intangible assets with indefinite useful life, and intangible assets not yet available for use. These three items. If you have indicators of impairment, do the impairment testing. If indicators are available, do the impairment testing. Even if the indicators are not available for these three assets, these three intangible assets, as it is not getting amortized, always there's a risk of overstating the asset value. What it says is, irrespective, even the indicators are not available, impairment testing is to be done at least annually. This annual test has to be done at the same time. It can be done at any time during the reporting period, but it has to be on a consistent basis, right? Other than these three assets, any other assets, any cash generating units, other than these three items, you do the impairment testing only if indicators are available. If the indicators are available, impairment testing. If there are no indicators, no impairment testing. Are we clear? Are we clear? Now you have a strong base to answer this question. You can easily answer this question. Now the question is, accountant has gathered information about these three cash generating units. Do we need to do the impairment testing or not? Right? What is the first unit? Medical equipment unit. This unit includes non-amortizing licenses, intangible assets, but no goodwill. Performance of the unit exceeds the initial expectation. Now it's your time. Give me the answer. Yes or no? Do we need to do the annual impairment testing or no? If you need to do, you can mention yes. If not, you can mention no. What do you say? Yes. What is the reason? No indicators. That's fine. Under the normal rule, no need to do the impairment testing. But you have an intangible asset, you are not amortizing. Which means you believe that it has an indefinite useful life. So which means that has to be that particular cash generating unit. Now the medical equipment unit has this intangible asset with indefinite useful life, which is not getting amortized, so that you have to test that for the impairment. It's a must, right? If you look at the answer, medical equipment unit required. It has intangible asset with indefinite useful life, hence annual impairment test is required. No indicators, because why? Unit is performing than it is expected. Performance are really good. No impairment indicator, but you have one of the three exceptions to the rule. You have an intangible asset with indefinite useful life, so that entire unit, medical equipment unit, must be tested for the annual impairment test. Right. Let's move to the hotel. Again, you can give the answer. This unit does not include intangible assets or goodwill. Nothing. No intangible assets or no goodwill. A significantly adverse future performance is expected from the unit. Future performance are expected to be adverse, not that good. What do you say? Do we need to test that for the impairment? Yes or no? Here, nothing under the exception rule, but you have what impairment indicator. What is the impairment indicator? Future performance are not going to be good. You have problems of generating the future cash flows. Then normal rule. If you have indicators, you have evidences, future performance are not going to be great, so that test that for the impairment. Annual impairment testing is not required as it does not have goodwill or intangible assets. However, significantly adverse future performance is an internal impairment indicator. Therefore, impairment testing is what? Under the normal rule, general rule, you have to do the impairment testing. Then don't misunderstand. Some people believe that it has an intangible asset means annual impairment testing is must, right? Not the case, right? Not for, because I specifically mentioned to you, not now, let's say having an intangible asset, and also if you amortize that, let's say you have a copyright or a patent, which you amortize over a period of time, then it doesn't mean that, okay, annual impairment testing is a must, right? Because only these three types of intangible assets are considered as exceptions. Goodwill, then intangible assets which has indefinite useful life, and the intangible assets which are not yet available for use, which means intangible assets in the development stage. All three are not getting amortized. That's why it's a must to do the annual impairment testing. But if you have intangible asset which is getting amortized over a period of time, then it's not coming under the exception. Then you have to go ahead with the what? Normal rule, looking at the impairment indicators. Okay, clear? Right. Third unit, tell me the answer. Automobile unit. This unit does not include goodwill, no goodwill. This unit has invested a significant amount in a project that has correctly capitalized all expenses as intangible asset. Okay, there are certain expenses capitalized, project-related expenses capitalized as an intangible asset. Amortization of the intangible asset is yet to commence. That means what? Amortization has not yet started. You just capitalize the cost, which means what? This is an intangible asset not yet available for use, which means it is in the development stage. No amortization. There's a risk of overstatement of the intangible asset value. Annual impairment testing is a must. Okay. Annual impairment test is required as it contains intangible asset not yet available for use. Are we clear? Very simple, right? When you understand the logic, answer the question is very simple. Right. Okay, that is done. Then going to the next step we have discussed up until now, let me give a heads up before answering to the next part. Okay, that is, now let's say you decide after conducting the impairment test in this way, you decide there's an impairment loss or not, because there can be two results. After you do the testing, there can be an impairment loss. In this case, in this example, there was an impairment loss, or else you might think that, or you might conclude that there's no impairment loss. Let's say in this situation, carrying value is not 1000, carrying value is 800. If the carrying value is 850, recoverable value is 900, that means that there's no impairment. There's nothing called impairment profits or impairment gains, right? Don't book those. It's only a loss. Loss or zero, right? If carrying value is 850, recoverable value is 900, no impairment loss. That's it. Right? Now, in this case, if you recognize the impairment loss for an individual asset, let's assume this particular example is relating to an individual asset, one asset. Then booking this impairment loss of 100 is very simple and straightforward. You credit the asset account and debit that to the profit and loss account. Very simple and straightforward. Nothing complex. But the complexity arises, let's say this impairment testing is done for a cash generating unit. We learned that cash generating unit has many assets, number of assets. Then if you figure it out, there's an impairment loss of 100, I should know to which asset should I allocate. What is the order of allocating this impairment loss of 100? Because it has many assets. What is the order? Again, if I give you a heads up, so this is the order. When you test the cash generating unit, including a goodwill, and you find out there's an impairment loss, this is the order that you need to follow. First of all, any assets which are obviously impaired. In the question, the examiner might give you a hint to say that, let's say there's a particular machinery in this unit, and there was a fire in the factory, and the machinery were fully destroyed, which means there's no value of this machinery. So if you have an impairment loss, allocates to those assets which are obviously impaired. These are called as demolished assets. Allocate to the demolished assets. Another example would be, examiner might say that company has taken a patent for one of the production process, but now competitor has come with a better technology. Now the patent that you have is useless. There's no use, no value. Again, what? Demolished assets. Obviously impaired assets. Allocate there. Thereafter, allocate to the goodwill of the cash generating unit. After doing the allocation to the other assets, if the amount is not enough, allocate to the other assets on pro rata basis. But this pro rata basis, you need to be very careful. Why? Why? Listen this carefully. Examiner might say that, let's say, within the cash generating unit, you have a property. Okay, property has a carrying value, let's assume a carrying value of 50 million. In the question, examiner might say that this particular property can be realized at 70 million, which means carrying value 50. If you can realize, if you can sell that at 70 million, he is indicating you not to allocate any pro rata basis losses to those assets. Because why? It already has a higher value in the market. You can sell the property at any time at that price more than the carrying value. Okay, so those type of indications can be provided. Not there in this question, but we understand. As well as you also need to remember, if the cash generating unit has these assets which are scoped out, example inventory, trade receivable, where this particular style is not going to be applied. So those are normally, like inventory, trade receivable. Those things do not allocate any pro rata basis losses, because why? We believe that for those assets, these specific standards have been applied correctly. If you have any losses, those have already been recorded. Then don't apply the general asset impairment standard for assets what is there in this list. They are part of the cash generating. You have to remember that aspect as well. So in this question, actually, in this cash generating unit, you have inventory and trade receivable. Inventory, company would have applied LKS2. Trade receivable, company would have recognized the impairment allowance as per SLFRS 9. Then don't allocate any pro rata basis losses for inventory and the trade receivable, because not within the scope of LK16 general asset impairment standard. Right. Okay, now you can easily answer. Student doesn't have any knowledge about the standard. Now with this explanation, I think I believe that now you should be able to answer. Right, look at this now. Finance team of XYZ correctly assessed that transport unit, another cash generating unit of the company, requires impairment test. So you have to carry out an impairment test, which means you have to compare the carrying value with the recoverable value as at 31st March 2023. So the cash generating unit comprise following. You have been given the carrying value of each and every asset of the cash generating unit. Building 100, motor vehicles 200, there's goodwill figure 300, inventory 10, trade receivable 15, altogether carrying 355. Value in use is estimated to be 300 million. Fair value exposed to sell is determined to be 290 million. What did we learn? Recoverable value is what? Higher of value less cost to sell and value in use. What is higher? Value in use 300, fair value less cost to sell 290. So always you go for the higher option, right? You recover the higher value. If you see that value in use is higher, you select that option. You continue to use the asset and generate future cash flows. So recoverable value is 300. This would become recoverable. Right? On the other hand, carrying value is how much? 355 million. So what do you say? Is the cash generating unit or the assets in the cash generating unit, is it impaired or not? Yes, it is impaired. Because why? Carrying value is higher than the recoverable value by 55 million. Total impairment loss also we know. It has to be 55 million. But the question is, this is not a single asset. This is a cash generating unit which has 5 assets: building, motor vehicles, goodwill, inventory, trade receivable. Where should I allocate this 55 million loss? Right? That is the question. Based on the information available, propose how the impairment loss of the transport unit should be allocated as at 31st March 2023. So what I did was I prepared this Excel. I kept this Excel sheet prepared. So what I did was I have taken the carrying value of all the 5 assets as at 31st March 2023, goodwill 30, inventory 10, trade receivable 15, building 100, and motor vehicles 200. Right? So I have taken that. Then what we know is we can now what would be the total impairment loss? Carrying value 355. Carrying value 355. Recoverable value 300. That means total impairment loss has to be how much? 55. That you know for sure. Right? This has to be 55. Total. Where you should allocate? Follow the order. What is the order? Do we have any assets which are obviously impaired? Demolished assets? No. Right? No indications about assets which are obviously impaired. Then if you don't have any assets which are obviously impaired, then you go for the second one. What is that? Allocate the impairment loss to the goodwill. So how much is the goodwill? How much is the goodwill? So you allocate 30 here. Out of 55 total loss, you allocate 30 here. So after you allocate the impairment loss first to the goodwill figure would become what? Adjusted carrying value would become 0. Then after allocating to the goodwill to the other assets of the cash generating unit on what basis? Pro rata basis, right? So some students have given the correct answer, right? Pro rata basis. You allocate to the pro rata basis. What do you mean by that? Other assets on proportionate basis. Inventory, trade receivable, building, and motor vehicles on pro rata basis. Is it? Is it? Remember about these two. I told you. Inventory and receivable. Can we allocate any losses? No. Because why? Those are not within the scope of LKS 36. So if there's any loss or impairment loss of inventory, that would have been already recorded once you apply LKS. Again, with regard to trade receivable, if there's any impairment loss, it would have been accounted under SLFRS 9, impairment allowance. So don't allocate any losses to these two. Right? Which means remaining 25. What is 25? 55 out of 55, you have allocated 30 to the goodwill. Remaining 25, you need to allocate to where? Building and motor vehicles. So how much to the building and how much to the motor vehicles? So I would say building, how much? Out of 25, right? Now, what is the value of the building? 100. What is the value of motor vehicle? 200. Altogether, what is the value of these two, building and motor vehicles? Where you need to do the pro rata basis allocation, 300. Then remaining impairment loss to be allocated is 25. Out of 25, you allocate 1/3 to the building, which means total is 300, 100 plus 200, where the building value is 100. So I would say I will allocate 25 into 100 divided by 300 to the building, which is how much? 8.33 to the building. Then motor vehicles, how much? Same approach, out of 25. So what is the value of the motor vehicles? 200 divided by 300. You need to allocate to motor vehicles, which is how much? 25 multiplied by 200 divided by 300, which is how much? 16.64. Right? You can allocate for the building 8.33 and motor vehicles 16.67. So adjusted carrying value would be after deducting the impairment losses. So no allocation to inventory and trade receivable, that is same. No change there, right? 10 and 15. Building value would be 91.67. How did you come? How did you get that? 100 minus 8.33, 91.67. Building motor vehicles 200 minus 16.67 pro rata basis loss allocation. It would be 183.32. Right? So if you add all these allocations, it will come to the total of 55. Right? So carrying value minus the impairment loss allocated to each asset, you derive the adjusted carrying value. When you take the total of these adjusted carrying values, it would be 300. That is 355 minus 55. This is equal to the recoverable value of the cash generating unit. That is the adjusted carrying value. Right? This is what you need to show. 30 to the goodwill, nothing to inventory and trade receivable, pro rata basis loss allocation to building and motor vehicles. Okay, pro rata basis loss is calculated. You take the relative value of building and motor vehicle. Building 100, motor vehicles 200. Total is how much? 300. This is the formula. Right. So that is what it is for the part B of the question. Part B of the question. Are we clear? Understood? So anyway, I have included the answer. So I have included the answer over here as well, right? But in Excel, actually, I have included the detailed calculation as well. So here also you have the answer, right? Okay, so with that, we are done with question number 3 of the paper. Okay, is it clear? What I will do is actually, it's a paper because even though I have taken almost, close to 4 hours, I couldn't complete because with the question, I'm not just answering to the questions. I'm explaining you the logic and the important aspect that you need to know in terms of your examination as well. Because of that, it takes more time than, can't complete the discussion within 3 hours. So what we can do is way forward. So basically what I will do in terms of the other questions, we can have question number 4 and 5. Question number 4 and 5, which is already there in the tutorial, which I have shared with you, PowerPoint presentation, what I have shared with you. You have the answers for the question number 4 and 5 as well. So those two questions I will discuss on 28th November, right? That is on Tuesday from 7:30 to 9:30. Okay, so what is it? So the question number 4 and 5 of this paper I'll be discussing on Tuesday 28th. Tuesday 28th in the evening 7:30 to 9:30, right? Then the remaining two questions, that is section C of the paper, which is very importantly consolidation question, including the inflation and complex accounting standard question, that is question number 6 and 7. I'll be discussing on December, I'll be discussing on December 9th, not next week, right? December 9th, Saturday, starting from 9 a.m. Is that clear? So 2 more sessions, right? 2 more sessions. First session would be on 28th November, 7:30 p.m. to, I would say, 9:30 p.m. Right? That is on November. Right? 28th, yes. Then the final session on December, which is on December 9th. 9th December, we can start at 9 a.m. to maybe 1 p.m. We are going to to discuss section C. Section C. That is question number 6 and 7. Right? Here, remaining questions of section B, that is more specific question number 5. Okay, so this is the plan. In order to do it at a rush, we have time for the examination. So we'll do it in that way. So CS Sri Lanka has shared this in the text box as well. So we have the details. So we'll do it in that way. So hope the session was helpful. So then I'll see you in the coming sessions. And a tutorial which I have shared with CS Sri Lanka, they will share with you once again. Right? They will share with you once again. If you have not received, what you can do is you can contact CS Sri Lanka administrator and get the PowerPoint presentation. So they will definitely share with you, right? Right. Okay. So let me make a conclusion of this session then. So thank you very much for your participation, seeking your active participation for the coming sessions as well. Right. And also, if you need anything to be improved or something to be, communicated, you can put in the chat box.